of 33,000 from the prior.
Esper says he will not in place. Snapchat has yanked Donald Trump hurtful to the
election, especially for those first-time voters.
Of a makeover,
it's a massive win, and I have to tap into retirement accounts and investments, bonds, stock, be part of that investment, and I do
exactly what it will only be fun. But keep in mind, private equity funds, you have to have a certain amount of income that's now available.
I want to know more about it. I want to
too.
know exactly how it works because I'm intrigued by it. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelleton. Up Wednesday as investors cling to optimism for a quick economic recovery from the pandemic. NASDAQ 100 index briefly surpassing its February closing record. Banks led the S&P 500 index.
week. Florida and New York State also posted new jobless claims of more than 200,000 last week, although most states did see a drop in the level of new claims relative to the week before. Also want to look at those continuing jobless claims, since those did continue to rise. They hit a fresh all-time high of more than 25 million for the week ended May 9th, and those are reported on a 1-week lag. And it points to the millions of individuals who remain persistently unemployed during the coronavirus pandemic. And this was above consensus estimates for just over 24 million, and continuing claims a week earlier were revised down slightly to 22.5 million. And then finally, want to point out that we have the advanced seasonally adjusted insured unemployment rate up by 1.7 percentage points, now to 17.2%. So overall, yet another tough week for the labor market. We do have stock futures trading down just slightly amid this report. Alexis?
And Emily, we're getting some more clues on how consumers are behaving during this pandemic, if they're spending, and if so, what they're spending on. We've got Best Buy out with earnings this morning, and also the parent company of TJ Maxx and Ross Stores. How did they do?
Well, taking a look at Best Buy, we did have results lower compared to last year, but they did beat consensus expectations on both sales and profit. Taking a look at first quarter enterprise comparable same-store sales, those were down 5.7% in the U.S., but still better than the 11.2% drop expected. Now, the largest comparable sales growth drivers were in computing and gaming, so really seeing a boost from the work from home phenomenon we've seen over the past couple months. But these sales gains were more than offset by declines in home theater, mobile phones, digital imaging, and services. Digital sales were also a major contributor to Best Buy's results. We saw U.S. online comparable sales up 155% over last year in the first quarter. And as a reminder for Best Buy, that company did shift all of its stores to curbside pickup only in the middle of the first quarter, although the company does now have about 70% of its overall retail locations open by appointment only. And then taking a look at TJ Maxx, or TJX, the parent company of TJ Maxx, we did see first quarter net sales down by more than 50% over last year and did miss consensus estimates. Also swung to a loss in the first quarter with its adjusted loss per share at 74 cents. But do want to look at the bright spot here. We have TJX beginning to reopen its stores globally. It now has more than 1,600 locations open. And during that fiscal quarter ended in May, TJX did have a total of more than 4,500 stores. So a large percentage of those are at least beginning to reopen. And TJX did say it's seeing very strong initial sales overall at stores across all states and countries that have begun reopening in at least the past week. And it believes that most of its stores can be reopened by the end of June. Taking a look at these stocks, we do have Best Buy off about 3.8% in pre-market trading, but looking at TJX, quite the opposite story there. Those shares are up 6.3%. Alexis?
All right, Emily McCormick, thank you. Want to talk more now about the jobs picture in this country with Beth Ann Bovino. She is U.S. Chief Economist at S&P Global. And Beth Ann, always good to see you. Welcome to the show again. I was reading your notes, and you are very big on infrastructure as a way out of this jobs recession. You say we had a great opportunity after the Great Recession of 08-09. We didn't take advantage of it. Why is now the right time to do this?
Well, think about it. We have record low interest rates. We have very cheap material prices and an unemployment rate, which is at, again, another record low. It seems the perfect time to be able to take advantage of this. And also keep in mind, infrastructure has been lagging for some time in terms of spending. That also means that we're failing in many places. We had done an analysis where we would see that if we invested about $2 trillion in infrastructure spending over a 10-year period, that would add another $5.7 trillion to the economy and create 2.3 million jobs in just 4 years.
Beth Ann, where are we failing, and how would you allocate that $2.1 trillion in spending?
Well, there's so many places it could go. The roads are certainly in disrepair. You look at the Society of American Civil Engineers has the U.S. infrastructure graded at a D plus for the last 7 years. The World Economic Forum has really scaled down the quality, or given the quality of U.S. infrastructure has dipping lower and lower and lower. And one perfect example is look what happened with public health infrastructure. We weren't able to meet the demand that was required during the pandemic, and so a lot could be done there as well.
What do you make of the market activity, Beth Ann, recently, given the economic backdrop? I mean, have investors really embraced this possibility that the recovery may be a very, very long road back, and have valuations sort of met that mindset?
Well, I think markets are markets are very forward-looking, so they've priced in the huge recession in the first half of the year. We have this recession down about 12% cumulatively, which is 3 times greater than what we saw in the Great Recession. I think markets have pretty much wrote it off. But the question is what the recovery will look like. We're not expecting the recovery to the U.S. to return to pre-crisis levels for at least for 2 years. Markets seem to be a little bit more optimistic than we are, and I'd say probably other economists as well.
Do you think, though, we should be a little optimistic given the fact that, yes, 2.4 million Americans filed for first-time unemployment claims? That is still a historically high level, but it's off the highs we saw in mid-March. Sort of, it seems as though we've hit a peak with those weekly unemployment numbers. Should we be reading anything into that?
I do think that's something to keep an eye on. The good news is the levels, the number of people who are basically going to the unemployment center, I guess figuratively, is half what it was just in March. And so that's good news. The big problem, though, is it's still in the millions. We now have 39 million people who have applied for unemployment insurance over the last 9 weeks. It took the Great Recession, I think, over 80 weeks to get to those levels. So we have a long way to go. And the other factor to consider is how fast will they get their jobs back once COVID-19 is gone.
Beth Ann, I think some comments this week from Fed President James Bullard may have rattled some investors. He said, "We are at peak crisis now." I think a lot of people in the market thought we were in peak crisis in April. Do you think May is peak crisis?
In terms of the economy, well, think about it. What we're seeing is we have basically many more workers now on the dole, I guess you could say, with, as I mentioned, the significant numbers that are there. And the worry, of course, is businesses. The hopeful news was that once COVID-19 leaves the stage, that you would see businesses open up and they would bring back those workers. Those workers would return. There was incentives put into place with the Paycheck Protection Program. But first, the question is, will businesses survive this ordeal? And I think maybe that's what President Bullard was getting at. And second, if they do survive, will they have the wherewithal and the capacity to be able to bring those workers back? We expect that the unemployment rate will not reach pre-crisis levels until sometime in 2023. So that to me means the crisis is still ongoing.
So given all that, Beth Ann, do you think that investors need to brace for even a bigger shock? Are we going to see another return to the lows for this stock market, do you think, or is it just going to be a bumpy road, but we're not going to make new lows?
Well, I can't really speak on stocks because I don't cover that area, but I have to say I'm a bit more nervous, and so often I say when I'm nervous, maybe you should be too.
Do you think that stimulus is more important? Another stimulus package from Congress is more important to investors at this point than movement on a vaccine?
I think they're both equally important. The vaccine means if indeed we do have a vaccine, and if it does come into play, that means COVID-19 will not be a story 5 years from now. And that is a huge relief to many, many people. But the other point is that the vaccine, if it indeed, at least according to health professionals, is that a vaccine, even if we start to get close to one, it's going to take at least a year, maybe even 2 years to be able to have it up and running to inoculate our citizens worldwide. So that's still a long ways away. I think the stimulus that's being discussed here, I think is in a sense the bridge that will help the United States, our citizens, get to the other side, both our citizens and our businesses get to the other side. So, and I'm glad to see that at least the government is talking about that again.
We are too. All right, Beth Ann Bovino, U.S. Chief Economist at S&P Global. Great to see you. We'll see you soon.
Bye.
Brian?
All right, Let's head overseas and check in with Tom Belger. Tom, we got some Eurozone PMI data out this morning. Anything promising in that data?
Yeah, I think you can read the data two ways, really. On the one hand, there are signs of a bounce back in activity compared to the record lows we saw last month. More firms are actually opening up as the lockdown allows them to trade. The PMI reading 30.5 is actually not only much better than last month's record low 13.6, it's also better than expected by a Reuters poll of economists. And the thing is, though, on the other hand, that 30.5 is still way, way below the 50 mark that shows growth. Most firms continuing to see pretty crippling drops in output, and it seems slower than the recovery one analyst noted in China as it eased its lockdown in March. And firms are still slashing jobs at near record rates. So as one analyst said, this really buries any remaining hopes of a rapid V-shaped recovery and explains why the recent rally in European stocks is losing steam today. Brian.
And Tom, looks like UK's EasyJet has figured out a date to restart their operations.
Yeah, EasyJet's the latest in a string of airlines to announce more planes will be back up and running this summer. It's also followed others in saying that everyone will have to wear masks on board. There won't be any food on board. And it certainly lifted EasyJet shares this morning. Airlines generally have missed out on the rally in stocks that we've seen the past couple of months and really caught the headlines instead of a widespread job losses in Europe. Warnings recovery could take years. And EasyJet also admitted to a data breach this week too. The main problem, though, is there going to be the demand to make these flights profitable? Some analysts are pretty skeptical. Brian.
All right, I'll take it. Thanks so much, Tom Belger. And we'll be back right after this. We have reached a morbid milestone in the fight against COVID-19. There are now over 5 million confirmed cases of coronavirus around the world that has resulted in over 328,000 deaths. Anjali Kemlani is joining us now for more. And this is certainly a grim milestone, Anjali. And I'm wondering if the spread of the virus across the world is showing any signs of abating at this point.
Yeah, Alexis, unfortunately, the answer to that is no. We have seen, when you pick it apart, really, you see, some trends, but it's very different in every place, similar to how we saw it was so different in various states. And that trend continues as well. While we know the major hotspots that we saw before, like New York and the West Coast, have been on the decline, we have still seen some states that are actually seeing increases in hospitalization right now, like Georgia, Alabama, Wisconsin, among others. Meanwhile, in the world, just like the US was a hotspot before, following Asia, following Europe, we're now seeing it trend into South America and other areas. Unfortunately, the answer is no. We know the World Health Organization said yesterday that they saw the largest increase of cases in 24 hours then, and that this virus is, to quote, going to be with us for a long time. So that is currently the situation.
Now, I know the U.S. just made a pretty big investment in a vaccine together with the company AstraZeneca. What can you tell us about that?
Right. So what they've done is invested $1 billion in AstraZeneca to help produce the vaccine that Oxford University is working on. And that's a pretty significant step because all the other companies, including US-based ones, that are actually developing the vaccines, they have invested far less in those. So I think that speaks a little bit to the significance of Oxford being a little bit further ahead along. If you compare, we know we talked about Moderna the other day, and they're being further along in the US, but overall it's China and then Oxford that are really in the lead here. Interesting note about AstraZeneca, they actually have a stake in Moderna. It's about a 7%, 8% stake. So that's going to be really interesting to see whether or not that results in, any partnership there in any way. So that's, what we're looking at right now.
All right. Thanks a lot for that roundup, Anjali Khemlani. And as just about every state now in the U.S. has reopened to some extent, a majority of Americans are sending a very clear signal to government officials. Take your time. That is the finding of a new AP NORC poll, which says the vast majority of Americans fear lifting restrictions will lead to more infections. And even a majority of Republicans say keeping some restrictions in place are appropriate. Our editor-in-chief, Andy Serwer, is with us now for this. Andy, I have to say, I wasn't too surprised to hear these findings. What about you?
Well, it really depends on how you look at it, Alexis. I think a lot of people see the demonstrations, for instance, at the Michigan State House, where, hundreds of people showed up, very vocal. Some of them had firearms. People are concerned. They want, to take back America, open up America. And you can extrapolate and say, well, geez, it must be like, over 50% of people in Michigan want to open up the state. Well, no, that's not the case. I mean, you're talking about literally hundreds of people in a state with a lot more than that. So I think people have to be very careful about a vocal minority representing anything more than that. And this new poll from the AP that you're talking about here, it suggests that 70% of Republicans are concerned about reopening America leading to new infections. And so, there you have it.
Andy, too, it's just not even, the reopenings are a major issue, of course, but I think what's getting lost a little bit is like reopenings are looking different. It's not like businesses are returning back to normal and everything is, look at restaurants, there's a lot of social distancing going on there, pretty much retailers, curbside delivery only. The landscape has changed dramatically.
Yeah, I think that's a very good point, Brian. A lot of people think that it's a binary kind of decision, that you're either at home and you can't go out at all, or we're back to a free-for-all that we Americans love so much. You want to go to the Yankees game. I know Alexis wants to do that so desperately with her kids, for instance. But
you know my household. Yeah, that is true.
That's right. But that kind of thing is not going to happen for a while. And so it's very nuanced. It's going to take steps, and it's going to happen differently in different areas. I mean, we're going to see restaurants with social distancing, offices with social distancing. If you're in a situation where you're at a farmer's market, like I've been over the weekend, people are spreading out. There are going to be different ways of paying for cash, paying for, things as well. So expect things to be a little different and to change and to vary very greatly in terms of where you are.
Well, do you think then, Andy, that the Trump administration is a little out of touch with what Americans are feeling and going through right now? Because President Trump continues to push for a big reopening. And we know that he has always sort of talked about the economy and taken the credit for a good economy and a good stock market, even when he was on the campaign trail. So is this more about politics reopening the economy, you think, for President Trump?
Oh, for sure. I mean, there's a couple things going on with Donald Trump, if I can put him on the couch for a second, Alexis, right? Number one, I mean, first of all, he is a master of rhetoric. So in other words, if he's hoping to get a 75, he's going to be asking for 100, right? And so I think even he knows that, number one. Number two, he desperately wants, like any president perhaps, to get reelected. Fair enough. So he wants to make sure that the economy is going full bore. Possibly at the expense of more people getting sick. Yes, that's a calculus that he seems to be willing to take, and maybe other people are as well. And then I think it also, the third point is that it really helps to energize his base. Those people I was talking about at the State House in Michigan and their brethren all across the country get energized by this, and there's a conspiracy, and we need to take back America. And you can see where that's going. So all that plays into, yes, November and the big election coming up.
All right. You know, we've been talking about it a lot here and on the Electionomics podcast with Rick Newman that a lot of polls are now pointing to Americans being dissatisfied with the way President Trump has handled this pandemic and how the coronavirus may actually be the thorn in his side for re-election. Andy Scheuer, thanks as always. We'll see you soon.
Thank you.
All right. We also have a programming note for you that we want you to take note of. If I can get to it here. We're going to be having a special coming up on mental health. This is going to take place on the 27th of May here at yahoofinance.com. We're going to have more on what that special is and when you can tune in just a moment. We'll be right back. Americans continue to lose their jobs at a historic pace. This morning, we learned that another 2.4 million Americans applied for unemployment benefits in the latest week. We have stock futures lower as a result. Let's check in with Jared Blickery now for more on market action. Jared?
Yeah, just looking at the Wi-Fi Interactive, we can see mainly red around the world with a few green spots, such as London. The FTSE's up about 15 basis points. But the S&P 500 is under a little bit of pressure here, just coming off of the highs that we saw yesterday. And I just want to broaden this out to a 1-month chart because we can see still kind of trapped in this trading range, although it has been very frustrating for traders. We did break out just a little bit to the upside, just as we broke a little bit to the downside. So just in this trading range and the breakouts kind of leading to these failed momentum trades. So I think we are going to see a breakout within the next week or so, but historically, May has been a tough time when we have these steep declines that we're facing in the current market. You go back to 2001, 2008, it was May in those years that we had a sell-off, and then we had about a 50 to 60% retracement to the upside. And then right before Memorial Day, we put in another top, and we led to steep declines thereafter. So hopefully we're going to buck that trend, but we'll have to wait and see. Just taking a look at one of our heat maps here, we can see the NASDAQ. The color coding is from yesterday, but we can see that the NVIDIA is one of the leaders here. Chip stocks doing well, and we can also see travel stocks as well. Expedia is up about 4%. Ross Stores is up about 3%. Facebook, another record high set for the open here. It was up 6% yesterday, set to be up another 2% today. And let's take a look at some of the sectors here. Cruise is kind of mixed. We're seeing Royal Caribbean up about 1%. That's after reporting earnings yesterday. In terms of hotels, we can see also another mixed picture here. The Wynn Resorts is up about 10 basis points. And then restaurants, the food industry, mainly in the green. We're seeing Darden up about 0.2%. And looks like Cheesecake Factory is up about 0.5%, Alexis.
All right. Thanks a lot, Jared. And a quick programming note. On Wednesday, May 27th, Yahoo Finance will air a special called Reset Your Mindset. We're going to bring together industry thought leaders, newsmakers, athletes, celebrities, medical experts for an open conversation on topics about wellness, mental, emotional, and physical, and how it all translates both at home and into the future of the workplace. So you won't want to miss that. We'll be back with the opening bell right after this. And the trading day is underway here on this Thursday, May 21st. We saw stock futures under some pressure and the Dow starting the day off 40 points. Let's bring in Daryl Cronk now. He is president of the Wells Fargo Investment Institute. Daryl, good to see you here again. I'd love to know from your vantage point, are you seeing any technicals in the market right now that show you that investors' appetite for risk is starting to improve a little bit?
Yeah, actually, we're at really key technical levels here, Alexis. Last night, we closed just above the 2965 on the S&P. That was a key level, which actually looks a little bit bullish. If we were to cross the 3,000 200-day moving average, there's nothing but blue sky between 3,000 and probably 3,200 on a technical standpoint. So these next couple days, albeit low volume likely with Memorial Day coming, do matter for the market technically where we are. If we fail into today and fall back, then we failed into resistance in a recession, and we're still stuck in this range between the 50-day and the 200-day.
Daryl, the move in the NASDAQ it's amazed me. I'm sure it's amazed a lot of investors. Do you think we're due for a short-term breather and we've reached peak NASDAQ?
I don't know that we've reached peak NASDAQ, but I would agree with you, Brian. The move has been eye-popping. I think we're up 21, 22% now on a rolling 12-month basis, which is almost unheard of. Certainly the online platforms continue to show strong top-line growth and good bottom-line growth. I was looking even last night. So if you take technology and communication services, it's now 35% of the S&P, which exceeds, going back into the 1999, 2000 levels of telecom. So we are getting, we think, a little bit frothy here. We're due for a pullback. We wouldn't be surprised to see that. The economic data needs to continue to improve from here. I think interesting this morning on continuing claims, while they were lower than the previous week, they're not improving at the level we want to see them improve. Losing 2.4 million jobs is still a lot of jobs on initial claims. So we do need to see the data improve. We need to see good news continuing to hit the market, we think, for it to set new highs and keep advancing.
Okay, Daryl, so if things are getting a little frothy in the market right now, what are you doing with your portfolio? I mean, what are you overweight? What are you underweight?
So we're still actually overweight in the portfolio, fixed income, mainly credit. So we're taking advantage of the credit spreads as things have tightened. We're a little bit underweight equities. Our risk budgets are down right now below, right around 90% of our long-term strategic weightings. So we have a little bit of a more conservative position here sitting at these levels, Alexis. We think that makes sense here. We've just run a long ways. This has been a historic V-shaped recovery for the equity markets, even though we don't anticipate the economy to experience a V-shaped recovery.
What about outside of U.S. equities right now? How do you view small cap stocks, but also how do you view emerging markets? Are you playing in there at all?
No, we're actually unfavorable small caps and unfavorable emerging markets right now. We still think you have to favor the U.S. over international, and in particular, we want to be up in quality in large and mid cap and down in quality on small cap. Small cap continues even year to date to underperform the S&P by 1,100 basis points as of this morning. So smalls, they struggle when the economy is still where it is. Unemployment rises. They typically have more leverage on the balance sheet, which is not an advantage in a recessionary period. So we expect weaker and more timid earnings growth out of the small caps.
Daryl, what's your expectations for summer trading? Typically, volume dries up in the markets as everybody goes on vacation, but we're all still working from home, and those vacations may not happen. How do you think that will influence markets?
Yeah, I think it's an excellent point, Brian. You may actually see a more normal summer to the spring and the fall type activity because people aren't going away. They're not traveling where they are. So I would actually expect volumes to stay relatively consistent through the summer months and not tail off like they normally do. That could actually be an advantage for markets because you don't get, typically when volume dries up, you get these extreme moves in markets. Small amounts of either news or sentiment can push markets too far on either direction. So I'd actually be happy if volume maintained through the summer. I think it's a critical time as we experience the reopening, as we look at high frequency economic data to judge whether the reopening is taking a hold in a good form or not.
What do you see as the next big catalyst for this market? Is it a new stimulus package from Congress? Is it news of a vaccine, which, I mean, we see how bumpy that road can be. The market sort of reacting to any headline we get on a possible vaccine, which is still months, if not more than a year away. To your mind, what is the next big catalyst?
I'm not sure there's exactly one, but I would give you a couple, and I think you named some of them there, Alexis. You've got, we do think you need to have fiscal and monetary action continue. So the degree to which Congress continues to step up here and meet extensions of unemployment claims and kind of filling that gap. Fed Chair Powell has been out recently in a number of speeches talking about his concern about the economic recovery and where the economy stands. Certainly the reopen and the vaccine path are very important to the market, maybe arguably the most important elements to the market. The high frequency data we think matters, so you got to keep your eyes and fingers on the pulse of the high frequency data. And then even though we've suspended almost a third of the S&P's earnings guidance, earnings estimates, consensus estimates are still too high for 2021. They need to get reined in and come down, in our opinion. So markets will have to deal with that as we advance through the summer months and the second quarter earnings season.
I'd like to check in with Jared Blickery now for what's happening here in the markets in the early going. Jared, what are you keeping an eye on?
Well, just looking at the broader markets, Dow is just up nominally, and we're talking about liquidity and coming into the summer months here between May and Labor Day. They have that old saying, "Sell in May and go away." Are we going to see that happen this time around? Also talking about the seasonality when we have these steep declines followed by a rebound going into the summer, not only in 2008 and 2001, but also with respect to going back to 2010, just coming off of the crisis. In May, we had the flash crash, and we do have lower liquidity. And to Daryl's point, that does exacerbate the price movements that we see. So just taking a look at one of our heat maps here, we can see the NASDAQ, kind of a mixed picture. Most of the FANG stocks in the green. Facebook at record highs here. Sorting by performance, we can see Ross Stores up 8%, followed by United Airlines and American. Those are up about 3% and 2% respectively. To the downside, Expedia down 2% after reporting earnings, followed by Analog Devices down about 2%. And then looking at the sectors, we have energy again in the lead. We have crude oil with a 33 or 34 handle in the July contract. Also looking at industrials, Boeing is leading in the Dow, up about 3%. Communication services being boosted by Facebook. That's about 17% of that entire sector. To the downside, we have healthcare, staples, and utilities. So kind of defensive there. Financials are lagging. We've seen them struggle a lot over this entire crisis, and they have been rebounding a little bit. Nice to see the KRE, the regional bank index, bouncing back, but under a little bit of pressure today, Alexis.
Daryl, would love to get your take on the FANG stocks right now. Seem to be holding up pretty well. You just saw Jared talking about Facebook. What's your feeling on those stocks right now? Are they a little too frothy at the moment?
I actually think they are a little bit too frothy. You know, they obviously are where growth resides right now, and that's important. But they've come so far and are now, as it's been well documented, 21% of the S&P 500, which exceeds the March 2000 prior peak of the top 5 stocks. Interestingly enough, if you take the top 5 market cap stocks, they make up the exact same market cap as the bottom 360 stocks in the S&P 500. So that's a phenomenal skew that's happening. We like the, call it, intermediate to long-term fundamentals. We just think that they're getting to be somewhat crowded at this point, Alexis.
All right, Daryl Cronk, president of the Wells Fargo Investment Institute. Good to see you. Thanks for being with us.
My pleasure.
And coming up next, we're going to hear from Coca-Cola's CEO about how his business is doing during this pandemic. Don't go away. Welcome back to the first trade. We're shining a spotlight on Coca-Cola now. That stock, along with a lot of others, have come under pressure recently. It's well off its highs, now trading at just under $46 a share. And it is starting to see some improvement in business conditions during this pandemic. Brian Sazzi is with me now. And Brian, I know you had a chance to catch up with Coca-Cola CEO James Quincy. What did he say about how the company's holding up right now?
Yeah, Alexis, it was just a few weeks ago where I think Quincy surprised many on Wall Street by noting global volumes were down 25%. So my question to him was simple. Does that mark the bottom?
We're seeing in two thoughts. One, we're seeing an improvement and really the predominant feature of the business in the very short term is going to be the degree of lockdown. The degree of lockdown, given that half our business is at home for at-home consumption and half our business is away from home consumption, the degree of lockdown is really what's driving the impact on the away from home. And as those lockdowns around the world are starting to ease in different ways and shapes and forms, there is a slight uptick in the business. But and that's a reason for cautious optimism. However, we have to be cautious because there is and there have been cases where it goes backwards. Just because it reopens doesn't mean it won't reclose. We can see in Japan, we can see in Singapore, we saw temporarily in South Korea that, as you open, you increase the risk of flare-ups and then the restrictions come back into place. So we see these reopenings, the reduction in lockdowns and reopenings as positive from an economic point of view. But we are also cautious that we are not necessarily witnessing the end, but yet the next stage of how this is going to play out.
So Alexis, James Quincy, to me suggesting that April might have been the worst in terms of global volume, seeing some improvement as you see businesses open around the globe. But I think Quincy's right. You have to stay cautious here because you could very much see, we have seen the return of hotspots, not just in the U.S., but also overseas, which certainly would impact Coca-Cola's business.
What did he have to say, Brian, about fountain soda? I mean, when you go to a restaurant and you get, it's not bottled soda, it's at the fountain. Sporting events as well, I would think, would be a place where that's happening. I would imagine demand for that has gone way down during these lockdowns.
Yeah, we have to touch fountain machines to get our big giant sodas, Alexis, or in my case, Diet Soda or Coke Zero. But I asked him about McDonald's specifically because McDonald's has come out with new social distancing guidelines suggesting they may not or they will not be reopening their fountain machines anytime soon. And keep in mind, Coca-Cola has partnered with McDonald's since 1955. Quincy told me that he's still optimistic that the fountain machines will come back. They're not permanently gone, but for now, likely to stay closed.
Yeah, I can imagine. All right. Thanks for that one, Brian. Let's check in with Jared once again for a commodities check. I'm seeing crude oil now above $34 a barrel. What gives, Jared?
Yeah, that's right. We have some incremental news that is positive for the crude oil space. Number one, yesterday we had the EIA report from the Department of Energy that was bullish. We saw a record drop in in supplies of crude oil at Cushing, Oklahoma. That's where all the WTI is funneled. That's where it's delivered in the U.S. And we also have some other news regarding the demand picture. We know that the IEA, difficult to, you don't want to get those two confused. The IEA came out last week and they said that there is improving demand picture, not as bad as it looked like before. Let's take a look at some of the charts here. We can see overnight still on the bullish side, but later to date, we can see still really under pressure. This is the July contract down about 38% here. And we are just pushing up against this resistance level. And we could see things kind of peter out if we don't get some more news here. But, considering the fact that we've come from negative 40 to 34, that's a $74 swing here. Just an incredible run for crude oil. Looking at the December contract, we can see it is up as well. The two contract here, so from July to December, they are still in contango here. That means that December is above, and this is the normal space for crude oil. But the spread between the two has dropped now, so it's not as wide as it once was. Brent now is about $37 for the contract in July.
All right, Jared, thanks. Yeah, energy investors definitely getting some whiplash here in the past few weeks. All right, Yahoo Finance, of course, was the exclusive broadcaster once again for the 2020 Berkshire Hathaway Annual Shareholders Meeting. You can watch all the top moments on our Best of Buffett highlights right here on Yahoo Finance, as well as on our app and your YouTube page. So when you have a little free time, check it out. It'll be worth your while. We'll be back right after this. As the economy wades its way into reopening and we head down our road to recovery, sectors, a whole bunch of different sectors are getting hit from all sides, especially real estate. We know hotels, retail stores really hurting right now. So what will the real estate industry need to do to come back? Joining us now to talk about this is Nora Creedon. She is Managing Director of Fundamental Equity at Goldman Sachs Asset Management. She joins us on the phone. Nora, good to have you with us today. Now, you say there are segments of real estate that are actually poised to benefit from this crisis. Outline for us what those sectors are.
That's right, Alexis, and thanks for having me on. So in the publicly traded real estate companies, we've seen equity declines of about 25% this year. That's up off the bottom of 45% declines we'd had at the end of March. But as you note, that doesn't really tell the story of real estate because there's huge bifurcation under the hood. So we've got about a third of the real estate world that is very directly negatively affected by the lockdowns. The hardest hit sector is hotels, which is probably obvious. We had a complete freeze of the global travel industry. We've got many hotels literally shut down, and it's very unclear how business travel and conferences will resume in a post-COVID world. Retail real estate that you mentioned also nearly as tough as hotels. Most malls in the U.S. were closed during this pandemic, and many shopping centers only had their essential stores like grocery open. And in contrast to the hotels, where they weren't losing business to another form of lodging, with retail, we know that consumers replaced whatever spending they were still able to do in online forms. So e-commerce penetration is undoubtedly going up through this. We may have accelerated years into that path that the consumer was already on. We can come back and discuss some other areas of real estate that have been very sharply hit. So senior housing facilities, office real estate, some other areas as well. But on the other end, we've got about a third of the real estate world that's actually seeing benefits from this strange new world that we find ourselves in. Here I'm talking about cell towers, data center companies, industrial logistics, real estate. I'm picturing right now the viewers of this show, they're probably working from home. They're tuned into Yahoo Finance. They're connecting on Zoom calls and Google Meets. If they have children, they're running online distance learning programs. Maybe they take a break from all this work and they do an online yoga class because their favorite workout studio is closed. They're ordering their food, their essentials online. If they have a minor medical issue, maybe they're doing a virtual visit with their doctor. And at the end of that long day, they're going to download a couple of movies on Netflix. So when you think about all this activity, it is just a massive amount of bandwidth needed and mobile connectivity and cloud connections. And we have companies we can invest in the REIT space that own these cell towers and small cell sites and data storage facilities. And these companies are doing really well. And on the industrial logistics side, these companies, they own warehouses, last mile distribution facilities. They were already doing quite well going into this. And the acceleration of that e-commerce trend I mentioned earlier is a direct benefit to their business. One interesting stat on that is that it actually takes about 3 times as much physical space to manage your e-commerce distribution than traditional brick and mortar retail because of the complexity of shipping single items to an end customer versus distributing goods between warehouses and stores. So the trend toward more and more e-commerce, it's great for logistics real estate.
Wow, Nora, I feel like you're in my house. You just described the day in the life of me and my family, you know, as the way we're using all of our data and our bandwidth. I think you hit the nail on the head. But what about office space, workspace going forward? Before this pandemic, shared workspace was the thing, right? And now people get as far away from each other as they can because of the pandemic. So is the future of those shared workspaces really doomed at this point?
Right. Well, look, on the one hand, I wouldn't extrapolate all of the current behavior into the future forever. I do believe humans are social creatures. We thrive on interactions. And I think you can see from some of the behavior in reopened states, there is a strong desire to return to our normal way of living. But we are spending a lot of time discussing what is the new normal, or should I say the new abnormal for office real estate in particular. The bigger cities like New York that are dependent on mass transit systems to get their employees to work, the technology that exists today, it's incredible, right? It's permitted so many white-collar employees to work from home effectively, and it would be sort of crazy for us to come through this experiment and think this won't cause certain companies to rethink their real estate footprint. You've heard that from many CEOs in the last few weeks. And rethinking that footprint could mean everything from permitting employees to work from home to relocating more of the workforce to more suburban office locations, places where people can drive to work, where it's more affordable to have real estate that allows people to socially distance at work, and that is all very possible. The one offsetting positive for office is that the push towards more and more densification, more people crowded on open trading floors and companies putting a lot of people in small square footage, that has likely come to an end. And I should say that, look, the impacts of these shifts, if they play out, it's way beyond just office. You know, think about the residential impacts in cities like New York, the street retail that supports the workforce in urban cities. If this occurs, there will be shifts well beyond just the office business.
Nora, real quickly, what you're saying on the mall really rings home true to me. Lots of stress on the mall. I think we continue to hear that. What does that mean for the commercial real estate market this summer? The market back, just in terms of the securities trading.
In terms of the securities trading, whether people will have more time, you mean for trading because they're not in the mall?
Well, just the commercial mortgage-backed security market. You know, should we expect a pretty sizable sell-off?
Sure. So, yeah, there is a good portion of the retail real estate industry that is securitized in the commercial mortgage-backed security market. And so far, we have seen some initial indications in the April numbers that some owners of malls are requesting relief, but that's all we've seen so far. So I think the story there is still to be played out. And I think we'll know a lot more in the next 6 weeks as we get the reopenings of these retail real estate facilities and see how do the tenants proceed to pay rent. And then I think we'll have a lot more color on that.
All right, we're going to leave it there. Nora Creedon, Managing Director, Fundamental Equity at Goldman Sachs. Thank you so much for being with us. Great insights this morning.
Thanks for having me.
All right, let's get one more check of the markets here with Jared Blickery. Jared, we're just bouncing in between small gains and losses. It looks like investors searching for direction here on this Thursday.
Yeah, it's nice to see the markets kind of taking a pause here. We've seen a lot of volatile action, both to the upside and to the downside. Just looking at the NASDAQ 100 here, we can see the big cap, big mega cap stocks here, pretty much in the green. Facebook up to a record high, up 2%. Sorting by performance, we have Ross Stores up the most, followed by United, and then Facebook, and then Starbucks as well. All of these in the green, but for the most part, stocks are under a little bit of pressure here. And we're tracking Boeing. That is up the most in the Dow, followed by Raytheon Technologies, and then Walgreen Boots. I do want to hit Baidu because this is an important development that we need to keep an eye on. Baidu may be reducing or maybe delisting from the NASDAQ and searching for a new home that is closer to China. And this comes after the U.S. Senate only yesterday passed a bill that could halt some Chinese companies from listing on U.S. exchanges unless they follow tighter guidelines with regard to audits and regulations. We know the Luckin Coffee debacle, where that stock has now basically is threatened to be delisted from the NASDAQ as well. But there are heightened tensions between the U.S. and China that we need to keep in consideration here. And if this bill does go through, it could pave the way for further tensions between the U.S. and China. Now, China shares make up a significant portion of a number of indices, including emerging markets, and Baidu is a part of the NASDAQ 100. So this could have important ramifications for years to come, Alexis.
All right, thanks a lot, Jared. And again, to recap on the jobs front, another 2.4 million Americans applied for unemployment benefits in the last week, still a historical level. In just the past 9 weeks, 39 million Americans have applied for unemployment benefits as this pandemic locks down our economy. Stay with us. The first trade, more to come right after this short break.
Welcome back to the first trade. I am joined by my co-anchor, Alexis Christoforous. Before we touch more broadly on the markets, let's drill into some stocks with Inez Ferre. Inez, you have your eye on Best Buy after their earnings report this morning. Looked somewhat decent, but a challenging quarter nonetheless.
That's right, Brian, with Best Buy saying that overall same-store sales were down 5.3% for the quarter. Comparable online sales, though, increased 155%. Right now, the stock is down more than 1%. Its adjusted earnings came in at 67 cents per share. And CEO Corey Berry said in the middle of Q1, we shifted all our stores to a curbside-only operating model, and we're able to retain approximately 81% of last year's sales during the last 6 weeks of the quarter, even though not a single customer set foot in our stores. Year to date, that stock is down just 8%. Looking at TJX companies, soaring today, up more than 7% after its first quarter fiscal year 21 results, with net sales coming in at $4.4 billion, a loss per share of 74 cents. The company wrote down inventory by approximately $500 million as a result of temporary store closures. It began reopening stores on May 2nd and gave some positive guidance there, saying while still early, the company is seeing very strong initial sales overall at stores across all states and countries that have been reopened at least for a week. So some color there from TJX. And then just taking a look at BJ's Wholesale Club, that stock today soaring more than 10% after its first quarter results. Comparable club sales, excluding gasoline, increased 27%, including digitally enabled sales, which grew a whopping 350%. And adjusted earnings coming in at 69 cents, reflecting a 165% year-over-year growth as consumers just stocked up on essentials. Brian?
All about that bulk chicken at BJ's Wholesale. Thanks so much, Inez.
Thank you.
Let's stay on the markets here with Salita Marcelli. She is the Deputy CIO for the Americas at UBS Global Wealth Management. She joined us on the phone. Salita, good to speak with you this morning. I look across a lot of sectors of the market, more specifically the NASDAQ, and to me, they're starting to look a little toppy. In your view, what's the next upside catalyst for the markets?
Good morning, Brian and Alexis. Great to be here with you. So yes, and actually, this is one of the topics that is most hotly debated with our clients as well. It's the valuations. Investors are pretty much weighing whether the valuations are out of whack with the economic reality. And let me put it this way: like, I believe in the recovery process, as far as the markets are concerned, we're going into the next phase, right? The first phase was driven by liquidity injections, stimulus package, but also, as you mentioned, significant outperformance of large caps driven by mega cap tech firms who are the beneficiaries of the stay-at-home economies. As I think the economies open up, which is what everybody is watching very closely, and people get back to their more or less normal life, those sectors which represent physical economies should lead, right? There's no doubt that liquidity injections have not been as powerful for small caps or mid caps as they did for large caps, which have done pretty well, given the nature of the quantitative easing, corporate buying. But we think, parts of the market that have lagged, like mid caps, are going to be at the sweet spot of both benefiting from central bank actions and take the lead in the opening back economy.
Salita, is that where you see valuations looking attractive right now in those underperforming mid-cap and even small-cap stocks at the moment?
Yes, I mean, small-cap stocks are much more levered play. And, let's be frank, we're not completely out of the woods. There is still the risk of a second wave. Right, and also more probable volatility that's going to come to the market from the U.S.-China tensions. But mid-caps, that's why I said are the beneficiaries of the opening of the economy and probably less levered play. When you look at the overall market, right, the valuations, like you said, it's toppy. So rather than adding overall to equities, it's these intra-equity rotations where you can find opportunities in lagged segments. I think that's going to help drive nice returns.
Salita, I was on a call this morning. Macy's CEO was holding an update on the state of their business. And I'm on this call, and I'm just listening to them talk about staggered store openings, the stores they have opened already. Not a lot of people are showing up. What they're doing is curbside delivery. And my main takeaway was, wow, earnings estimates for the S&P 500 are just too darn high. Do you share that sentiment?
It certainly looks fairly valued, overall market valuations. And it's going to be key to see how corporations and individuals are going to be reacting to the easing of the lockdown, right? So I think there's going to be winners and losers. Yes, the restaurants are not going to get filled up very quickly, but I think, for example, quick service restaurants are going to be beneficiaries. So you have to pick and choose the areas that are going to be benefiting from the recovery. What we have done, for example, is look at areas that might be the earlier beneficiaries, like for example, from back to work or back to play. Maybe it's not going to be, like you said, the stores that's going to benefit from it, but there's segments within the industrials and materials that might be key beneficiaries of a rebound in manufacturing, because as the economy begins to reopen and hopefully unemployment rate starts to fall, people are going to start coming back to business, and manufacturing is probably be the earlier beneficiaries of this. Also, you have like gasoline refiners, auto parts retailers that might be the earlier areas where we see improvement, especially when people start driving in summer months.
In that regard, do you think we are getting ready to see a rotation from some of these big cap tech stocks like FANG into some of the industrial stocks that I think still haven't really caught a bid?
Yeah, I think it's too early to call the rotation right now, but within the next month or two, I think there is a likely the case for that is improving for sure. It's all going to depend on how investors' perceptions will be about how the second wave is going to play out. If as we open up, as we watch the impact of easing of the lockdowns on hospitalization rate, and we realize that maybe there's going to be a second wave and it's going to be more manageable, or maybe it won't be as big of a second wave at all, then I think you would start seeing that rotation.
I'm curious your take on energy right now. We're seeing oil prices well off their lows. Crude oil is actually above $34 a barrel right now. And energy has really been sucking wind out of this market. Do you see some pockets of opportunity there?
Well, yes, but it's a difficult one because energy oil has suffered from the double shock, right? Both on the supply side and on the demand side. We have some supply cuts, and actually we're seeing some of the U.S. Producers cutting their production faster than we originally anticipated, so that's helpful. The OPEC cuts are encouraging, but probably not enough. But more importantly, now we're seeing with China coming back online, the demand is picking up, and the hopes for the reopening of economies in the U.S. and Europe is certainly supporting the increase that we have seen energy prices over the last few weeks. The issue there with oil is that even though we see the spot prices moving, if you want to invest in oil, you are also subject to roll yields, and when you look at the curve, it's pretty steep. So it's too early to say this is the right time to get in, because your total returns are going to be less than the spot prices that you're seeing. So we are hopeful. Our view in the second half for energy prices is much more positive. I think we would be around by the end of this year with a 4 handle. But that said, it's too early to make a big call to jump in right now.
All right, let's leave it there. Solita Marcelli, Deputy CIO for the Americas at UBS Global Wealth Management. Thanks for taking some time this morning.
Thank you. Pleasure to speak with you.
And a programming note, be sure to tune in to Yahoo Finance on Tuesday for our continuing special coverage on the climate crisis. We'll examine the intersection of healthy profits and a healthy planet. Much more ahead on The First Trade right after this quick break.
and your internal world really begins to bubble up and manifest. You really get to experience a different relationship. Electrified emit different wavelengths by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age at time that the oxide coating can act to scrub whatever is left. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together, from the fixture together into a I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable
Compliance laggards such as Iraq. The Norwegian energy minister told us exclusively that she plans to see her nation's cuts through.
We are making a substantial cut now. When we come to December at the end of this year, we will be producing 300,000 barrels less per day than what was initially planned. So at the moment, I feel this is a good contribution. I think we're seeing already clear signs in the market that it's moving towards stabilization a little bit quicker than the worst fears. So we will end regulation by the end of the year, but at this time, this is the cuts that we are ready to go through with.
So at the moment, there's no talk of extending into 2020.
The situation is that we will see these cuts through to the end of the year, but then again, we can end the regulation quicker if we see that's possible. But on the onset, the plan is to keep these production cuts in place until the end of the year.
You said you see some signs of stabilization, and we are seeing that with the price of oil as well. But we still have more than 1 billion barrels in terms of inventories. How long do you think we will see like proper supply and demand stabilization in the market?
Well, I think it's difficult to say, and I'm sure there are oil and gas market analysis that can probably answer that question a lot better than me. But I think it's a good sign that we're now seeing the oil price going a little bit up. I think some of the worst fears that we had just a month ago about seeing storage globally go to max capacity is maybe something we're not as. But I think as more countries eventually start opening a little bit more up, and we're seeing some of the pandemic receding in some countries across the world, the hope is, of course, that people will start flying again, driving their cars. The economy will bounce back, even though we know it's going to take a while. And this will, of course, also affect the demand side in the oil market picture.
I know Oslo is starting to open up, or Norway in general. Are you seeing more demand pickup within Norway?
Well, we are seeing like one really example that you can see just by moving around is that people are starting to fly again. I think a lot of things have changed because of this pandemic. I think just having digital meetings on webcams, et cetera, is something that we're probably going to keep doing more, even though things come back to normal. So I think it's too early to say now exactly how this will play out, but we are seeing more people starting to move around, but we still have a really high focus on keeping the virus at bay. So we still have many measures in place to ensure that we have good hygiene, that we don't sit too close together, to make sure it doesn't shoot back up, because it is, of course, a major health issue that we take very seriously.
During the previous downturn in 2014, OPEC had invited Norway to come to the meeting. Have they done that this time around? Is this something that you'd be interested in doing?
Well, we were invited as an observer on the meeting that they had before they came to the conclusion of cutting production. We're not part of this cooperation. We're not a part of OPEC. I did not myself attend, but we were represented on our officials here in the ministry. We're not part of that group. Any production cuts that we make will be based on independent decisions.
And so it's hard to tell. I guess this confusion is only possible because it's a virtual meeting. You and I aren't meeting in Vienna as usual, so I suppose they could log on at short notice. But whether it's now or next week, I think there's a consensus, at least, to extend the current cuts, to avoid the tapering of the cuts that would otherwise take place. And so that means Russia and Saudi Arabia are aligned there. But what's taking longer and what might delay the meeting beyond tomorrow is the need to negotiate something new, a compliance mechanism, something formal Well, you know, it stems from something we've kind of forgotten a little bit in the discussion, and that OPEC has agreed to a 2-year deal here. And while they are relieved at the sharp recovery in crude prices and the accelerated shut-ins in North America, I don't detect any confidence they're out of the woods. The reopenings have yet to be proven successful. So the way they look at it, they're looking through September into next year, and they may need to continue cuts and their cooperation. And I think they see this as sort of shoring up poor compliance by notoriously by Iraq and by Nigeria and a few others, because they're batting down the hatches, if you will, for a long voyage, for the long haul. So this is looking forward to the next 2 years and realizing they may not be out of this quickly, and they need to get Iraq especially out of the habit of failing to comply. You know, initial estimates, we don't have full data, is Iraq only complied by about half with the 1.1 million barrel a day cut it was supposed to make. So they're going to, now that they sort of agreed amongst themselves on the extension, but the diesel demand is on the floor, like you say, 21-year low. Inventories, if you take a look at those EIA the Gulf, reflecting 1.6 million barrels a day. So we'll see what happens with inventories as that arrives. That could lead to some increase in inventories. But for now, the crude inventory picture is cleaning up, but the product picture is not. Gasoline stocks also rose by larger than folks expected to this week. As we talked about, distillate stocks are still high and rising, approaching record levels. And so products are telling us we're not out of the woods. Crude in the United States, Cushing is telling us we've avoided the worst.
Okay, CEO Bob McNally, always first with his views on the market. Bob, we'll speak to you very soon. We're going to take a very short breather. It's Daybreak Middle East. It's Thursday. We're going to talk a little bit more about the markets. This is Bloomberg. You've used it, you've logged on to it, you've had your virtual meetings with it. Have you been Zoom bombed? Well, they are in a position, they're poised to raise nearly $935 million in their US IPO this week, giving the company a valuation of $6 billion. Priced me up 44.5 million shares to go at just over $21 a share. They had been marketed in the range of $16, $17, $18. So there you go. Zoom me up, eh?
Yeah.
You like Zoom?
Who doesn't? It fits in everybody's diary. Let's get to the region's other stories, because Qatar's Financial Center's Purchasing Managers Index fell for a 14th consecutive month in May, according to a new report by IHS Markit. The headline number came in at 36.6. That's down from 39 in April, and it comes as Kuwait said there is progress in resolving a 3-year standoff between Qatar and its Gulf neighbors. Joining us now is Akbar Khan. He's the Senior Director of Asset Management at Al Rayyan Investment. The numbers are pretty gloomy on the PMI front, Akbar. I want you to give me a sense of what you're seeing on the ground over there.
Good morning, Yusuf, and thanks for having me back. In the environment that we have right now in Qatar, in the region with $30-40 oil, the environment is gloomy. It's obvious. It's compounded by the aggressive lockdowns that we've had because of in the world. They have more than 60 vessels, and are the primary way that Qatar sends its LNG to the rest of the world. So if they're going to be increasing production by 60%, and they just signed the largest contract this week for more
My name is John Chambers. I traveled deep into the Amazon jungle with my team where I uncovered a disturbing scandal taking place, with the press and media outlets now exposing it all. So I rushed to form a verified network of 12 nonprofit organizations using scientists, wildlife experts, and environmental engineers, all working 24/7 around the clock to take bold action. Now it's going viral.
8 billion trees.
And thousands of members are joining
8 billion trees. 8 billion trees.
8 billion trees.
8 billion trees.
to erase 2 tons of carbon free using a precisely calculated plan evaluated.
I can comfortably move in, but I have reasonably good qualified people with me. But I really think that I'm the target creator. I'm the guy who does the monthly performance reviews. I'm the guy who push the limits. I want people to work hard because I think we as human beings, our productivity is still low.
I mean, you spend a lot of time in property because that's where you came from. That was the first company.
True.
But what
So e-commerce excites me a lot because when I look at how people in these offices, therefore I really believe that the younger generation are running the world and they run it extremely well. So much learning in the digital side of the e-commerce. But I think my investment in MEVP, which is a private equity firm that specialize only in digital and technology in the Middle East with almost 80 ventures. That's amazing learning about what's going on in the Middle East as well and the industry that are about to come.
Do you focus a lot on diversity for your companies? Is that important?
Yes, very important, very important. And I think it's happening naturally. I mean, we don't even have to do it anymore. It's just naturally. That's how.
So do you have metrics?
We have metrics, we have KPIs for that. But as I said, it's so nice that it's really embodied in the organization. It's happening automatically, and I like that.
Do you think it will increase with time, or are you going to see more female workers?
Well, the female workers are really taking charge. I mean, if you look at the people who run my organization, most of our organization, I would say most of our organization, our food boys have to have more of that. But look at our government. Highest percentage of senior people in government anywhere in the world.
Mohammed Alabar, thank you so much for joining us. He is, of course, the chairman and founder of MR Properties.
Thank you so much.
Thank you.
Thanks.
In line, HSBC and Standard Chartered both back Beijing when it comes to the proposed security law in Hong Kong, the latter saying it will maintain stability in the region. So we are just under an hour away from the start of cash equity trading in Europe. Let's take a look at what futures are doing. We see red arrows, albeit small red arrows. FTSE futures down 0.2%. DAX futures unchanged right now, and we're starting to see U.S. futures actually turn higher. In terms of the Dow Jones, at least, Dow Jones futures contracts are now rising. S&P and NASDAQ futures contracts still down about 1 or 0.2%. So, Anna, it looks like, we've had some incredible gains. It would be pretty amazing if this continued, but the market doesn't really want to sell off.
Yeah, we were talking earlier on this week about whether this was a really unloved rally. Well, it does seem to limp on, even if it's in its unloved state. Let's look at the GMM function then, Matt, and look at what's been happening in Asia. The session has calmed a little, does seem to be limping a little compared to the earlier sessions of the week, but still making some modest gains to the upside. A mixed picture, though, coming through in Asia. But we do have some markets to the upside, the Australian market, the Philippine market, Thailand, so some of these names moving higher. Elsewhere, we have Hong Kong and China under a little bit of pressure. We do have a bit of a movement in the dollar, though. There's some the dollar recouping some of its losses back from the highs of March. Of course, we've seen a big drop, and so now we see a little bit of a recoup of that. So we do have a bit of a signal of risk off in these markets. But yesterday we saw once again equities moving higher globally. The ADP better news on jobs out of the US that helped us to take a bit more of a risk on stance, didn't it? And led banks in an upwards direction. But today looking a little bit more muted in terms of the global gains we're making. Matt?
All right, let's get to the first word news then right now. From the Bloomberg terminal, here are today's top stories for you. Former Defense Secretary Jim Mattis has strongly criticized the president's handling of unrest across the U.S. He says President Trump tries to divide the American people, accusing him of making a mockery of the Constitution. This comes amid uncertainty around the current Defense Secretary, Mark Esper's position. He publicly opposed the president's idea of deploying military in the U.S. to contain protests. Germany's ruling coalition has agreed on a 130 billion euro stimulus package. The wide-ranging plan is even bigger than had been anticipated. It includes a temporary reduction in the VAT tax, as well as money to rebuild or to build 5G networks, to rebuild the country's railways as well. Tense negotiations finalized the package, took 2 days.
Das heißt, wir konnten nicht nur einfach ein Konjunkturpaket. We couldn't just set out a stimulus package that was done in the traditional sense. Rather, it had to be a package of measures that contained a view to the future, and this is precisely what we have emphasized. The package will amount to 130 billion euros for the year 2021, of which 120 billion will be spending by the government.
A reshuffle of the FTSE 100 and travels out. Airline EasyJet and airplane parts maker Meggitt have been demoted to the mid-cap FTSE 250. Promotions include a number of so-called stay-at-home stocks. Kingfisher, the owner of B&Q, will now be on the benchmark, as will cybersecurity firm Avast, boosted by more people working from home. The changes take effect on June the 22nd. Global news 24 hours a day, on air and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, futures then, as we established at the top of the programme, looking a little bit more mixed this morning, even though there are some quite clear positive catalysts, I guess, for risk appetite versus what we saw earlier on this week. In Germany, 130 billion euros of stimulus package. That's larger than expected. We've had news of that overnight, came quite late, of course. The ECB is widely expected to boost its pandemic bond buying programme today, and data showing a manageable contagion rate across Europe means that reopening is likely to continue. Keeping all our fingers crossed about that, of course. Let's discuss all of that now with Laura Cooper, our Markets Live macro strategist here in London. picture, isn't it? Given all of these seeming positives around fiscal stimulus, around the stimulus expected, at least from the ECB, you might have expected the market to move higher, but I guess much of that was discounted already.
Well, absolutely. I think, the reason that we're seeing kind of futures on the back foot is it just comes off this exceptional period where we are seeing this buy everything rally occur in equities. And I think today there's a little bit, of some risk built in, potentially the fact that we could see the ECB potentially show some reluctancy in terms of actually expanding their bond purchasing program. So a lot of these efforts are focused on kind of these stimulus hopes. And if that begins to kind of unwind, then that could certainly kind of keep risk assets kind of in this more muted mode instead of kind of powering forward on these expectations of reopening success.
You wrote a piece on what happens when the stimulus ends. This can't go on forever. I think Germany's recent package is expected to be the last one, at least until the elections at the end of next year. What should we be looking forward to, Laura?
Well, I think that is the question. It really just how much can stimulus continue to keep investor appetite satiated? Because up to now we've seen this exceptional policy coming in from the Fed, and that has really reduced the infections or even growing unrest, and we have to expand. But even we are going to see some pressure in those markets, and I think investors are just not yet attuned to the fact that this degree of stimulus is really unsustainable over the medium term once we get beyond kind of this initial shock of the health crisis.
And that brings into question what's pushing up various assets, Laura, including the oil price. I know that you've been thinking on the Markets Live blog overnight about how far the oil price rally can go. Brent prices have been above $40 a barrel for a while, haven't they? And indeed just dropping below that, so 39.31 right now. How far does this rally go? And is it all tied to expectations of OPEC, as is ever the case?
Well, I think it's a combination. Yes, we are seeing kind of these optimistic, actually going forward, it's going to be, more of a demand side as well, because we are seeing these economies reopen. And so that is pointing to positive signs going forward for a medium-term demand outlook. But ultimately, if we see any kind of stumbles in terms of that aspect of the supply-demand equation, then that certainly would likely keep or higher that we saw late last.
Strategist out of London. You can join in the debate on today's question of the day for the MLive blog. How far will crude's rebound rally go? If you have some input to share with us, go ahead and reach out. Type IB plus TV go on the Bloomberg terminal, or just email me and I will forward your answer on. Coming up, Merkel's stimulus plan, the German chancellor's spending package tops expectations by 30%. But the auto industry falls short of its goal. More on Germany next. This is Bloomberg.
I'm good, thank you. You?
I'm doing terribly well. I've been listening to a lot of the Doobie Brothers lately, which just improves your mood, you know?
Frederic, have you been listening to a lot of the Doobie Brothers?
No, I haven't, but it's now on my list.
Welcome back to Bloomberg Markets. This is the European Open. We are over 45 minutes away still from the open of cash trading after you know, the massive rally that we've had over the last few trading days, especially here in Germany, we're finally starting to see a little bit of a sell-off indicated in futures. Speaking of what's going on in Berlin, Chancellor Angela Merkel's coalition agreed to a sweeping 130 billion euro stimulus package designed to spur short-term consumer spending and get businesses investing again. Alongside an immediate jolt by a temporary reduction in the value-added tax, Germany allocated money to build out its 5G data networks, improve railways, and double down on incentives for electric vehicles. In one of the most contentious issues in the talks, the auto industry fell short of its goal of getting direct government support for purchases of conventional cars. We're joined now by Frédéric Carrier, Head of Investment Strategy at RBC Wealth Management. Frédéric, good morning. Welcome to the program. What do you think of the German let 1.3 trillion euros flow out into the economy?
Good morning, Matt. Well, look, it is good news. I think a lot of investors have been eager to see more spending out of Europe and in particular out of Germany. So this package, which is, as I think you mentioned, more than a third larger than expected, is really good news. And so it's the second week that we have good news coming out of Europe. Last week we had the proposal from the EU Commission for a joint response to the crisis, which would have been which the proposal is for 6% of EU GDP to spend that money. It's a positive step towards fiscal consolidation. It's only a proposal. It's very likely it's going to be watered down eventually. However, there's positive news flow at the moment at a time where valuations are still
cautiously optimistic. And Frédéric, what do you think the ECB should do in response then? Because they've already done a lot and they haven't spent all of what they put aside by any stretch in terms of that PEP, the PEPP fund that they already have in place. So there's a lot of market
has given to the regional economy compared to what the US has done. That would suggest there's still room to be more active and upsize its pandemic emergency purchase program. Having said all that, we don't have yet full clarity about this joint EU proposal that I mentioned. There are also reduced pressures clearly from financial markets. So it could be that an announcement is pushed back a little bit later into the summer. But for now, we do expect another 500 billion euros to be announced from the ECB, so for the ECB to upsize its purchase program.
You know, don't fight the Fed is an old market adage. Have you had investors who are simply following the money, as John Authers put it in his most recent column? I mean, from the start, we've been of this crisis, we've been getting big stimulus injections all over the world, plus massive bond buying packages from central banks.
So
Wealth Management. Stay with us. We want to pick up on those thoughts a little bit further, talk about your strategy from here, because some people are asking this morning if the party is over for global stocks. Equities strike a slightly less optimistic tone overnight than we've seen in recent sessions. So is all the good news priced in? We'll talk about that next. This is Bling Bang. Welcome back to the European market open. Still just under 40 minutes to go until the start of equities trade. It does look as if we'll be a little bit more sluggish at the start of the European session. Futures point downwards by around 0.3%. Now, Asian equities traded broadly higher today, but with less of the enthusiasm of previous days, perhaps. So is the optimism in risk assets for a quick economic recovery from the coronavirus pandemic now priced in? Let's talk to our guest a little bit more about her strategy. Frédérique Carrier is Head of Investment Strategy at RBC Wealth Management. And Matt asked you in our last conversation, Frédérique, about following the central banks in what they're doing. We've seen this German stimulus overnight, and I wonder if your strategy involves following the visions of European governments at all, because within the strategy that we heard about from Germany is money for electric cars, for rail and for 5G.
The way the EU intends on financing its joint EU package, it would be by raising taxes or levies on single-use plastic and carbon.
What's going to be the overall effect of all this stimulus, though, Frédérique, on companies' earnings after this pandemic ends? Are we going to see a big bounce back, or is 2021 even going to be a difficult year for earnings?
So we think that in terms of the overall recovery, we think that despite all this stimulus, that the recovery is going to be a slow one and certainly an uneven one. And we that economies will go back to pre-COVID crisis level until early in 2022, and the economies won't go back to full potential until the end of 2022. And so we think that overall the market is maybe a little bit overly optimistic about level. It's a different crisis, of course. Back then, you had a lot of problems in capital markets, in the banking system that was not functioning for more time, in our view, than what markets seem to be implying.
What's your favourite trade at the moment then, Frédérique, as we look ahead to the ECB, all the things we've talked about, the German stimulus coming, what we're going to hear from other central banks over the next week or so? What is your favourite trade?
So the best risk-adjusted returns, in our view, come from fixed income. Credit spreads have still potential to narrow. They have narrowed already, but they have more potential to narrow from here. And of course, it's an asset class which is supported by central bank purchases. And in particular, high yield in the US, high yield corporates are yielding 6.5% over treasuries. That's quite above the 10-year average of about 5%. There is a risk of default, but remember, there's a lot of fiscal and monetary support, as we've been discussing. And because, having said all that, the number of companies which are trading at distressed levels, so at premiums of 10% over treasuries, the number of companies that are distressed has halved since March. So while the possibility of default is there, it does seem to be a lot less, low enough for this asset class to be attractive to us.
Got it. Frédérique, thanks so much for joining us today. Appreciate your insight and strategy. Frédérique Carrier is Head of Investment Strategy at RBC Wealth Management. This is Bloomberg.
for an indeterminate amount of time. We hear a lot in our government in recent years about an open-ended, endless war against terrorism that seems to have no end, no boundaries. One of the thoughts I'm going to leave you with is we may be entering into a much more important over or not. I don't think so, not even close. We did have, and there was much attention paid to it, something called a recovery. It lasted from the depth of the bottom of the stock market, roughly March of 2009, and it was over by March of 2010. During that time, three things got a little better in the United States. Number one, the financial condition of our banks, particularly our big ones. Number two, there was a recovery of roughly half or so of what the stock market had lost. And number three, corporate profits rebounded from the worst times they had had in 2008 and 2009. All of those developments are now over. That is, if you saw today's announcement, the second quarter growth in the United States was about 1.6, 1.7%. That's a level of growth that is unemployed. And indeed, the perspective now is that unemployment, this is the official perspective of the Bureau of Labor Statistics, unemployment in the United States is likely to rise over the coming months. Not only not fall, but to rise. Bank situation has not gotten any better in several. I would submit to you that the recovery was a recovery only in part and for very limited sectors of the American economy.
Equity trading. Take a look at futures here. You see that we do have some red arrows across the board, both in terms of European futures and U.S. futures this morning after what's been quite a rally this week. Let's take a look at some of the key events happening today. The ECB publishes its official projections for growth and inflation, along with its policy decision, later widely expected to boost emerging leaders from 3 p.m. London time today. Also today, U.S. jobless claims for the month of May are due to be published. The downward trend is likely to continue with the number expected to fall below 2 million for U.S. jobless claims. And Hong Kong's annual vigil commemorating the 1989 Tiananmen Square massacre. Of course, it was canceled IRL, but it's been moved online after police banned the gathering for the first time in 30 years. Participants are being encouraged to hold candles and observe a moment of silence. Anna?
Session in living memory. The central bank is widely expected to add another 500 billion euros in emergency funds, even though less than a third of the already allocated 750 billion euros has been spent so far. The central bank is widely expected to add that extra money. So let's talk to Jörg Rockel, who is president of the European School of Management and Technology in Berlin. Jörg, very good to speak to you. We want to get your thoughts on the overnight news around stimulus for the German economy on the fiscal side, but given that introduction around the ECB, let me ask you about that first. Is there real concern in Germany about the role that the Bundesbank can continue to play in stimulus? We heard...
Very important question, and it's also a serious threat that the Bundesbank might not be able to continue supporting these programs going forward. Obviously, the decision by the Constitutional Court only concerned the previous program, but there were very clear conditions in the judgment by the Constitutional Court, for example, that the purchases by the European Central Bank or the banks in the European Central Bank system shall not exceed 33% of the issuance volume of one specific bond, that each national central bank shall only buy as much as what its capital key is in the equity capital of the European Central Bank. So therefore this needs to be watched very carefully, and thus also the decision by the German Constitutional Court needs to be taken very seriously.
Are they going to wade into the PEP program? Do you expect that to be next?
So it is very likely, in my view, that those who actually filed the lawsuit against the previous program will use the current program immediately to figure out whether they can go back again to the Constitutional Court. Then obviously this may take some time, but it has to be watched very carefully, in particular when the conditions under which the current program are run might be different from the previous program.
Is this tying the hands of the ECB, though?
The ECB has to take these concerns from the German Constitutional Court seriously. I think it would be dangerous if one simply ignored those measures. At the same time, one has to say that the ECB is really you could say, the only game in town, or seen as the only lender of last resort, given that the political measures were not sufficient to deal with the shortcomings of the not fully integrated monetary union yet. So therefore, also on the political side, many more significant steps are needed to complete the monetary union and to also augment it by an economic union, and thus also to take a little bit the ECB out of the fire.
You know, the ECB, Jörg, and Brussels, I heard from a lot of politicians in Brussels, would be great for the entire European economy. Now they're doing it and getting a little bit of pushback. What do you think about the stimulus?
Yeah, this is indeed a little bit an ironic situation that exactly for many years Germany has been pushed to spend more to provide really stimulus packages of a massive scale, and the very point of question of whether Germany can increase its competitive advantage over a very unusual situation, a situation in which also the economic crisis is worst in comparison to any of the other post-war years in Germany, and it simply is the situation in which the government has to do the steps to support the private economy.
So the measures that are being talked about or that have been approved in the German stimulus package, then, Jörg, are they the right ones to get the euros to the places that matter quickly enough to stimulate the German economy? Talking about the car sector, other parts of the infrastructure story as well.
Pet projects into it. So, for example, the Social Democrats wanted to get subsidies for families for their children, while the Christian Democrats wanted to get more investment money. So, therefore, you could say it is not really a very targeted, a very focused program, but rather it goes into almost each area you can think of, and by that way it tries to address as many economic agents as possible. So this means including companies, including consumers, and now the hope is, and that I think is maybe even more important than the money itself, to send a very strong signal of encouragement. You could even say a psychological statement that comes with such a significant amount of money.
All right, Jörg, thanks so much for joining us. Great to get your thoughts on these big, important, especially the case, but also the events that we're seeing here. I want to quickly bring you some breakers on the market. We had a report yesterday in Women's Wear Daily, or we talked about a report in Women's Wear Daily that said they might be considering pulling out of this. The board of directors of LVMH met on June 2nd and, quote, notably focused its attention on the development of the pandemic and its potential impact on the results and perspectives of Tiffany. So it does look like there's on the open market. Coming up, British banks defy the UK government and back China's Hong Kong security law. We'll discuss HSBC and Standard Chartered's moves and statements next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open right now. We are just under 20 minutes away from the start of cash trading, and we do see futures indicating a sell-off, a little bit of profit taking there, considering the rally that we've had at George Floyd. The Attorney General is also charging 3 additional police officers for aiding and abetting. It comes as protest region out of its deepest recession in living memory, and most economists expect an increase of 500 billion euros to the PEP, or Pandemic Emergency Purchase Program. And a reshuffle of the FTSE 100 is due. Travel is out. Airline EasyJet and airplane parts maker Meggitt have been demoted to the mid-cap FTSE 250 index. Promotions include a number of so-called stay-at-home stocks, including Kingfisher, the owner of B&Q, and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, let's talk about some other businesses with a London listing then. HSBC and Standard Chartered, 2 British institutions that dominate Hong Kong's banking system, have backed Beijing in the standoff over a proposed new security law. The bank's statements came on the eve of the anniversary of China's 1989 Tiananmen Square crackdown, and with the US gripped by violent protests. The timing highlights the growing tensions amid the coronavirus pandemic. For more, Bloomberg's Selina Wang joins us now from Beijing. And Selina, what is then the significance of these announcements from HS? Give us the latest.
Well, I first want to point out, Anna, that these aren't the first major companies to back Beijing and Hong Kong. In recent weeks, you've seen many major local businesses, including Taixing, the parent company of Cathay Pacific, and the city's largest developer, all voicing support for the national security law. That's despite polls showing broad public opposition in Hong Kong. That being said, HSBC and Standard Chartered are in this very unique and delicate position. Most of their earnings and has offered refuge to as many as 3 million Hong Kong residents. Now, when it comes to HSBC, Greater China accounts for 40% of revenue. Hong Kong's also incredibly important. And it's clear that the new CEO, Noah Quinn, doesn't want to get on the wrong side of the government. When it comes to Standard Chartered, they're less exposed to Hong Kong compared to HSBC, but Hong Kong is still Standard Chartered's biggest market. Of the $2.3 billion in underlying pre-tax profits made by the bank in Greater China in North Asia last year, 61% of that came from Hong Kong. But we have already heard some harsh reactions from British lawmakers, including Alistair Carmichael, chairman of the UK Parliamentary Group on Hong Kong. He said that, quote, "It's a colossal misjudgment because you cannot, as a British company the size of HSBC, be seen to be advocating for the fair and flagrant breach of international law in a rules-based system."
All right, Selina, thanks very much for joining us. Selina Wang there talking about the, to some, I think, surprising headlines that HSBC and Standard Chartered are backing Beijing over Hong Kong right now. Selina Wang reporting from the Chinese capital. Coming up, Merkel's stimulus plan, the German chancellor's spending package tops expectations by 30%, but the auto industry falls short of its goal. More on Germany next. This is Bloomberg.
Welcome back to the European Market Open. 13 minutes ago until the start of the equity trading session for this Thursday morning in Europe, and looks as if equity markets will slip a little. And in fact, those futures worsening in the last half hour or so, now down 0.6% on the Stoxx 600 futures. Oil also slipping from a 3-month high. That's as OPEC Plus unity, it seems threatened by a long-running feud over complying with production cutbacks. Bloomberg spoke to the oil minister of another crude producer, Norway, who said they're also making substantial cuts.
We are making a substantial cut now. When we come to December at the end of this year, we will be producing 300,000 barrels less per day than what was initially planned. So at the moment, I feel this is a good contribution. I think we're seeing already clear signs in the market that it's moving towards stabilization a little bit quicker than the worst fears. So we will end regulation by the end of the year, but at this time, this is the cuts that we are ready to go through with.
So at the moment, there's no talk of extending into 2021?
No, we're not discussing that politically or in the department ministries at this time. Right now, the situation is that we will see these cuts through to the end of the year. But then again, we can end the regulation quicker if we see that's possible. But on the onset, the plan is to keep these production cuts in place until the end of the year.
You said you see some signs of stabilization, and we are seeing that with the price of oil as well. But we still have more than 1 billion barrels in terms of inventories. How long do you think we will see like proper supply and demand stabilization in the market?
Well, I think it's difficult to say, and I'm sure there are oil and gas market analysts that can probably answer that question a lot better than me. But I think it's a good sign that we're now seeing the oil price going a little bit up. I think some of the worst fears that we had just a month ago about seeing storage globally go to max capacity is maybe something we're not as worried about right now. But like you point out, there is still a huge surplus. The demand is not back to where it was before. But I think as more countries eventually start opening a little bit more up, and we're seeing some of the pandemic receding in some countries across the world, the hope is, of course, that people will start flying again, driving their cars. The economy will bounce back, even though we know it's going to take a while. And this will, of course, also affect the demand side in the oil market picture.
I know Oslo is starting to open up, or Norway in general. Are you seeing more demand pickup within Norway?
Well, we are seeing like one really example that you can see just by moving around is that people are starting to fly again. I think a lot of things have changed because of this pandemic. I think just having digital meetings on webcams, etc., is something that we're probably going to keep doing more, even though things come back to normal. So I think it's too early to say now exactly how this will play out, but we are seeing more people starting to move around, but we still have a really high focus on keeping the virus at bay. So we still have many measures in place to ensure that we have good hygiene, that we don't sit too close together, to make sure it doesn't shoot back up, because it is, of course, a major health issue that we take very seriously.
During the previous downturn in 2014, OPEC had invited Norway to come to the meeting. Have they done that this time around? Is this something that you'd be interested in doing?
Well, we were invited as an observer on the meeting that they had before they came to the conclusion of cutting production. We're not part of this cooperation. We're not a part of OPEC. I did not myself attend, but we were represented on our officials here in the ministry. We're not part of that group. Any production cuts that we make will be based on independent decisions, based on what is good for our economy and our resource management.
Have they invited you, I'm curious, to the June meeting?
Not that I know, no.
All right, that was Norwegian Oil Minister Tina Bru speaking with Bloomberg's Anne-Marie Hordern. A little bit later, we're going to be showing more of that interview alongside conversations with other major players in the oil world. Catch our Bloomberg Live event, Powering Forward Crude Awakening, at 3 p.m. UK time on Live Go. Just type L-I-V-E Go on your Bloomberg terminal, or go to Bloomberg.com. You can also see it on LinkedIn, Facebook Live, and Twitter. Now, Chancellor Angela Merkel's coalition agreed on a sweeping 130 billion euro stimulus package designed to spur short-term consumer spending and get businesses investing again. The wide-ranging plan exceeded the top end of expectations by 30%. Joining us now is Raymond Kullert, our German government editor here in Berlin. So, Ray, who are the winners here and who are the losers?
Well, Matt, actually, they're only winners, aren't they? Because nobody's getting any money taken away from them, nor are conditions worsening for anybody. They're handouts. Now, there are people whose expectations may not be met, and clearly that would include the auto industry, which had been hoping for some kind of a cash bonus for purchasing cars. That hasn't happened, and that's a bit of a revolution in Germany, where, of course, auto is king, and that was also the case back in 2008, 2009, the financial crisis. The car industry got a big bonus. That didn't happen this time around. So they are on the loser list. Municipalities are getting less than they expected. And I can imagine one or the other environmentalists complaining about not going far enough on green stimulus. It includes, for example, new planes for airlines. That one will be debatable.
Right. So, Ray, good morning. So all of this money, handouts at the moment, but maybe someone will have to pay for it in the future. I say maybe. Who is going to have to pay for this in the future then?
Well, you can very well imagine that answer. As always, it's the taxpayer. It's not quite clear yet. Late last night, Finance Minister Olaf Scholz said that not all of this new money will be financed by debt. Remember, back in March, they'd already said that the debt ceiling could rise by as much as 156 billion euros. Part of that, there's still money left over from that. Part of that will finance the new package. So it's not quite clear yet. That's what we're going to be looking out for today, is where exactly the cash is coming from to finance all this. But in sum, it's bigger, it's broader, and it's surprising what we saw last night.
All right, Ray, thanks very much. I know you guys were up very late reporting and editing this story. I was following your coverage minute by minute. Fantastic job there. Raymond Kullert, our German government editor here in Berlin. Coming up, it's the market open. Futures are pointing slightly lower, but keep in mind we've had pretty amazing rallies, especially here in Germany over the last few trading sessions. The open is next with some profit taking expected. This is Bloomberg.
About whether you are in favor of deficit spending or you're not in favor of deficit spending. The cycle, the capitalist cycle, is working its way through its normal process. And what is its normal process? A period of unemployment that's extended until workers are willing to work for a lot less because they've been out of work long enough and the prospects look bleak enough that a job and a salary they would not have accepted before becomes something we'll have to settle for. Likewise, as the cycle unfolds and businesses go out of business, the cost of secondhand equipment drops because the sellers who are desperately going out of business outnumber anyone who's buying. And the rental cost of square footage goes down, and the lawyer you need to hire becomes desperate and will willing to work for less, and on and on and on. And when does it stop? When the costs of doing business have been broken down far enough so that a capitalist, an investor, a businessman or woman sees the prospects of profit at such low wages and such low costs, and then they go in, and then the system has another period of growth for 2, 3, 4 years until we're back in the same instability of this system, which no section or collection of brilliant economists has ever been able to figure out how to stop or control. That's what's going on. And I submit to you, that's why so many Americans are angry, because they're living this process. For them, these debates are empty. They're not moved, they're not interested, they're not drawn into them. The clever repartees lost on them. They see insecurity, decline, and no end. Are we surprised that they're rageful and angry, that tea parties attract them, etc., etc.? I don't see why. That people in that situation begin to look for scapegoats, somebody to blame, the nasty bankers, the awful immigrants, or whoever. That's also par for the course. The history is full of this. We don't have a government with policies that can solve this problem, and they have proven that to us. But they have done something. They've now saddled the government with enormous debts. And that is the new problem. It's a crisis displaced. It's not so immediate on the private sector, although heaven knows it's still there. But the urgent problem is the government. All around the world, all the governments, they've borrowed up to here. And so they're discovering a problem. And again, to be simple, what's the problem? When a government borrows, you feel comfortable because it's the government. It's not just some person or some company. But if the government keeps borrowing and borrowing and borrowing, then the same anxiety of a lender that applies to a private bank, you're an insurance company, you're the kinds of folks that lend to governments, and you see the rising indebtedness, and you say to yourself, uh-oh, as the government debts rise, the government has to use more and more of its revenue just to pay the interest and pay back the debts. So more and more of the money that people pay in taxes doesn't come back to them in the form of a service, of a school, of a firehouse, of an educational program, of an unemployment check, of a Social Security benefit. No, that's not available because the money has to go to pay off the lenders. And the lenders are not stupid. They know that this is not a sustainable arrangement. The political risk is that movements will develop that turn on their own governments and say, what are you, handmaidens for the lenders? Collection ladies? Bag people?
Maybe because of the bigger gains that we've been seeing on the DAX, we'll see a bigger loss. Yesterday, the DAX closed up 466 points. That was a 3.9% gain. So now, as investors take profits, European markets opening lower. The rally had propelled, by the way, the Euro Stoxx 600 index up 5% this week as well. That's despite the big positive catalyst of German stimulus, which the drops are despite the catalyst. We're going kind of back and forth between up and down and up and down. But the up arrow story, 130 billion euros added to the economy here in Berlin, 30% larger than had been anticipated. Joining us now is Pooja Kumra, Toronto Dominion Bank Senior European Rates Strategist. Pooja, what do you think of this continued stimulus, especially for the German economy?
Good morning. Yes, so this stimulus comes after what we had seen as the 750 billion package that was announced in March. And if you think about in terms of GDP, I think Germany is have spent around 8 to 9% in terms of the actual fiscal package, which is pretty sizable. But I think the recent package, which is for 130 billion, it's not sure whether it will be entirely new money or it will be partly from reorganizing whatever they already had. But I think we can surely assume that at least 50% will be new money, and German government has basically used their low rate environment to actually fund that. So we would actually expect more issuance coming from Germany, and that is pretty much likely in their quarterly update.
Yeah, we've heard from Olaf Scholz. Good morning to you, Pooja. He says that the sales tax cut will be a good impulse for the economy. Does this package tick all the right boxes for the types of measures that should be being introduced right now for consumers to get them spending?
Yes, indeed, they are trying to address every single measure, but it's something that we need to see that Germany has just started to reopen. Markets are still realizing the scope of reopening and how it will impact the economy. So I think even in terms for regulators, it's hard to at this stage see that what is the best measures. I think one thing that they really need to concentrate on is on the unemployment as well. But if we do see the European Commission package actually being ratified by the parliaments, I think that would be a big game changer for European countries across board, because that will be a good package in addition to the easing that we are seeing on a country basis.
You know, thus far, the recovery in the Stock 600, Pooja, compared to the recovery in the S&P 500 has been fairly anemic. Of course, the U.S. acted quickly with big numbers, but we're getting some pretty big numbers here as well. I mean, Germany has now allowed 1.3 trillion euros, more than $1.5 trillion to flow into the economy, and it's obviously a much smaller country. Why are European stocks continuing to lag?
I think that is something that is basically across board. I think we have seen this move since the beginning of the week. The markets are more, I think it's more of a positioning-led move, either before ECB, where markets are actually thinking that there might be not another package from Euro area. I think markets are just trying to be a little more careful. And I would less read into the German fiscal impact and today's markets move.
We've seen a bit of data coming through on the Eurozone economy in recent days that does seem to suggest some improvement, some recovery taking place. How meaningful is the data that you're watching at the moment, Pooja? What do you think is the most important impulse to be looking at?
All right, so in terms of data, definitely it's the reopening as well as how it progresses. So just to give you an idea, ECB is basically from their medium to severe scenario of contraction basically suggests that Euro area GDP could contract between 8 to 10%, so which is pretty solid. I think in terms of data, I think markets have also realized that recovery will not be just suddenly, but yes, it will be slow. And rates have not been reacting much to data as such. They are more reactive to monetary policy as well as supply side. So I think as we start reopening more, there'll be more focus on data, which has been lacking right now. But the key indicators definitely will be PMI, will be growth, definitely inflation. I think inflation with low oil markets have given up on inflation actually reaching anywhere close to ECB's mandate in near term. So those are key, but I think in the next few months, it's all about the stimulus package. I think that kind of will actually give the kind of confidence that markets want and the stability that we want to see.
Okay, Pooja, thank you very much. We'll pick up on that conversation next, actually, in terms of the ECB. Pooja Kumra, Toronto Dominion Bank Senior European Rate Strategist. We'll get to her perspective on what we can expect from the ECB, and do we see some big expectations out there? Show me the money, perhaps, is apt. The ECB's told to be bold with more cash for recovery as countries slowly start to open their economies after the coronavirus pandemic. There is market expectation. What will we hear from the European Central Bank? This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We're looking at some losses here with the DAX down 92 points, the FTSE off 25 as investors take some profits after the rally that we've seen over the last few trading sessions. Let's get the Bloomberg Business Flash right now. These are today's top corporate stories from the Bloomberg terminal. You have a reshuffle to kick it off of the FTSE 100. Travel is out. Airline EasyJet and airplane parts maker Meggitt have been demoted to the mid-cap FTSE 250. Some of the companies that have been boosted are stay-at-home stocks. Kingfisher is one. The owner of B&Q is not going to be on the FTSE 100, as will cybersecurity firm Avast, boosted by more people working from home. Those changes all take place on June 22nd, so mark your calendar for the move. Standard Chartered has joined HSBC in endorsing China's controversial Hong Kong security law. Stanchart says it will help maintain economic stability and social stability in the financial hub. The move comes despite critics saying the legislation will diminish freedom and violate the one country, two systems principle. Rolls-Royce expects to cut 3,000 jobs in the UK this year. It's the first wave of the reductions to survive a downturn in the aviation industry. The London-based jet engine maker ultimately plans to trim 8,000 roles from that division. Rolls-Royce is offering voluntary redundancy to all its aviation workforce and part of its back office staff as well. And that is your Bloomberg Business Flash. Anna, save me.
Yeah, the back office stuff. Let's talk about what's going on at the ECB then, Matt. The ECB will decide today whether its massive monetary stimulus needs to be further boosted to help Europe out of its deepest recession in living memory. The central bank is widely expected to add another 500 billion euros in emergency funds, even though less than a third of the already allocated 750 billion euros has been spent so far. Let's get the thoughts of Pooja Kumra, Toronto Dominion Bank senior European rate strategist. She's still with us. And Pooja, having read that and having looked at this a little earlier, I was thinking to myself, so why does the ECB really need to act now if they still have all of this PEP left? This is the pandemic-related fund that they put aside before, the 750 billion. Two-thirds of it is still left to be spent, and it's that and other measures have been effective in bringing down peripheral bond yields. So why is there urgency right now? And I wonder if it is to do with the inflation picture in the Eurozone. What's the urgency for you?
Yes. So yes, as you said, the PEP already has a lot of room. So far we have just used around 250 billion of the entire 750 billion package. But I think we need to see that in March and April, they were actually reacting to more of the sudden shock to the market, the kind of volatility that we saw in peripheral spreads as well as the June meeting. They will have the updated growth and inflation forecast. Now, I know for any central banker right now, it's very hard to predict where growth will be this year or next year. But we did see some papers being released by ECB in May, and that did suggest that the contraction could be as high as minus 12%. And that's a pretty big number that we've never seen before. And also given the fact that ECB has to maintain its inflation mandate. And I think in order to get there, they need to give more confidence to the market that they are ready to use all their tools. But again, we know it's coming, but it's basically whether they use this meeting or should they wait for another meeting. I think the only reasons why they could think about meeting for another meeting is, number one, we've seen some positivity with respect to the Euro Commission proposal, which basically has given some more hope to the markets. Secondly, also we do have the TLTRO funds coming in on June 18th. So they might like to see what's happening with that package before actually using the tools again. But I think the key, yes.
Pooja, can I just quickly ask? Sorry. The ECB's one of their biggest tools has been the Bundesbank, and in terms of quantitative easing, they can't find that hammer right now. If there's a problem, or do you foresee a problem with the Bundesbank taking part in PEP as well?
Yes, so that will be one of the key questions also that ECB will have to face during the press conference. So I think with respect to the Bundesbank's court ruling. First of all, it is basically on PSPP and not PEP. But I think after this ruling, we know that PEP will also be questioned at some point by the Bundesbank. Secondly, we also need to note that we did get a statement from ECB just after the ruling that they are doing everything within their mandate, and which is pretty much true because European Court of Justice did in December 2018 did tell us that ECB has been right in its ways and means to actually prevent any fragmentation and spreads. And it's all these limits, the proportionality, the 33% limits, they are all self-imposed by ECB, and that is something that has also been told by us by Draghi. So I think what we would see in the coming months is, and which we are already seeing in the May data, is that there are less capital deviations in the way the ECB is making their purchases. So in March, we did see a lot of Italy buying versus Germany, but that is less visible when we saw the May data. And I think that would be something that ECB will try to do right now, at least for the APP program, not really deviate with respect to the capital keys. And thus, maybe they are able to get a proper dialogue with the German court.
All right, Pooja, thanks so much for your time. Appreciate your input on such an important day, especially for the ECB. We'll all be watching very closely today. Pooja Kumra, Toronto Dominion Bank Senior European Rate Strategist there. She's going to be continuing the conversation with me on Bloomberg Radio at 9 a.m. UK time, 10 a.m. here in Germany. So if you want to hear more from Pooja, and we'll focus in as we get closer and closer to the ECB decision on what to expect out of Frankfurt today, tune in London, in the City of London. You can tune in on DAB Digital. Anywhere else in the world, go to the internet. You can figure it out. Bloomberg Radio is not hard to find. Up next, meet the Corona economy. Travel is out and stay at home is in. The FTSE 100 reshuffle. We'll look at the leavers and joiners. Next, this is Bloomberg.
we already were at record levels of debt on a number of measures from corporations when we got into January of this year. And one of my concerns was that when we have an economic downturn, this highly levered economy of ours was going to lead to more severe pressures on the economy than we would normally have. But now, the Federal Reserve has basically eliminated the downside in corporate debt. They've sent the world a buy signal, and we're now putting on record amounts of corporate debt. The leverage situation is even getting more exacerbated. So I think ultimately the Fed is going to find itself in a position where when it tries to phase out these programs of support for corporate debt, it will be a lot like what happened back in 2013 when Ben Bernanke first talked about ending quantitative easing. There was a tantrum. And so it's quite likely that the Fed will face that day of reckoning when it tries to slow down asset purchases of corporate debt. And the market will then challenge the Fed to find out where the put is. And I think this is now a permanent feature of the market.
So Bill Dudley has told Bloomberg that he believes that they're flirting with moral hazard here. What does that mean in terms of how companies may look coming out of this crisis? Help us understand what is at stake here.
Sure. Well, first off, I would quote Milton Friedman, who once said that nothing is so permanent as a temporary government program. The corporate America is going to become addicted to the Fed providing support. What I think it means, Sonali, is that corporations will take greater risk. That if you don't have a highly levered balance sheet relative to your competitors, your equity returns will be punished during business expansions. And so pressures will be on CEOs to continue to increase the amount of leverage, especially when the Fed has got a policy of maintaining low rates for an extended period of time. So I think that ultimately, is there a day of reckoning? I think that the Federal Reserve will be faced with the challenge of whether they allow a day of reckoning or whether they basically decide that they just have to continue to provide liquidity to the system until inflation rates pick up to levels that probably would be viewed as unacceptable by most participants of the Fed today.
Scott, we've seen record amounts of borrowing from corporations, but at the same time, if you look at downgrades, it's happening at a faster pace than we've seen in at least a decade. How do we pair off that thinking? Well,
it's really interesting, Sonali, because this, again, was something we had expected. We expected to see downgrades among high yield or in triple B issuers into the high yield category of about $1 trillion in a slowdown. I think that we're on pace to do that. But there's also another question, which I brought up today at the S&P conference, which is that the rating of a bond reflects the probability of default. And so when you have a government program that provides liquidity, you've taken away one of the major causes or sources of default, which is the inability to roll your debt maturities over. And so, you have to think that at some point, the rating agencies are going to start factoring in the implicit support of the Federal Reserve, and it's going to actually, in the longer run, reduce downgrades.
That was the Guggenheim CIO, Scott Minerd, speaking to our colleagues. Now, the latest FTSE 100 shakeup is showing the impact of the lockdown. Airline EasyJet and cruise ship operator Carnival are among 4 stocks leaving the stock benchmark. They'll be replaced by the likes of B&Q owner Kingfisher, so that's a home improvement business, and household repair group HomeServe. Joining us now is Joe Easton. Some of those main changes then on the FTSE 100, Joe, really a sign of the times, reflecting how we are not able to travel and have much fun anymore, but we can certainly stay home and do up our houses.
That's right. Good morning. So, yeah, as you mentioned, a lot of them related to the COVID-19 impact. Clearly, those ones you mentioned with EasyJet, we know they're cutting around 30% of their workforce. They've had huge declines in passenger numbers, obviously, and Carnival dropping out as well. It's probably one of the companies that potentially faces one of the longest recoveries, simply because it's very difficult to enforce social distancing in a cruise ship kind of environment. So analysts all across the board are very, very cautious on those stocks. And then the other one dropping out is Meggitt, which is a plane parts maker. So as you mentioned, they are really all quite travel related in terms of coming out. And then coming in, you mentioned they're Kingfisher, so everyone has more time at home, looking for things to do, so doing more DIY. And then the other one that's coming in is also HomeServe, which I should mention, which is essentially a company that provides emergency call-outs to homes. So it's a similar sort of thing, more time spent at home. And then finally, the other one to look at is British Gas, which isn't so much a lockdown story. It's Centrica, the British Gas brand, dropping out after 33 years. That's really more of a competition story. So they face greater competition from smaller rivals for around 15 years. So that's the only one out of 8 changes in total we've had that's really not related to COVID-19. The other ones, as you mentioned, related to lockdowns.
All right. Thanks very much, Joe. We're going to see these changes, I guess, on June 22nd finalized. So definitely investors should be watching their screens for moves in those stocks, as a lot of funds track and a lot of ETFs, of course, these indexes, and will be forced to buy or sell depending on the changes. Joe Easton there from our stocks team. Up next, the UK is on collision course with China from Hong Kong to Huawei. Up next, we discuss the Sino-British relations with Yu Ji. She is a China specialist at the international relations think tank Chatham House. This is Bloomberg.
Welcome back to the European Market Open. That open has been taking place for the last half hour, and this is what we've got for you across the European equity space. So European equity markets are under pressure. We're down by 0.4%. The FTSE 100 down 0.3%. The DAX down 0.5%, as is the CAC 40. Some of the bigger losses, though, coming at the Eurozone periphery. So the IBEX and the FTSE MIB both down around 1%. In terms of the sector picture that we've got for you then today, we've spent the last couple of days talking about all sectors in positive territory. Today, things not all red, but certainly a bias to the downside. Autos and parts, they've rallied a lot earlier on this week, and now they find themselves at the downside. Matt was talking about the Aston Martin story just in the break there, and that's certainly having an impact on that particular share price. The bank stocks and insurers also to the downside. We do have that sort of recourse to the defensives taking place today, and so healthcare, food and beverage, telecoms, those sectors going higher. Matt?
All right, let's get the Bloomberg First Word News. These are today's top stories from the terminal. Prosecutors have upgraded the murder charge against the former Minneapolis police officer accused of killing George Floyd. The Attorney General is also charging 3 additional police officers for aiding and abetting. It comes as the protests continue across the country, with President Donald Trump calling on New York to crack down on the unrest. Germany's ruling coalition has agreed on a 130 billion euro stimulus package. The wide-ranging plan is even bigger than had been anticipated. It includes a temporary reduction in the value-added tax, as well as money to build 5G networks and improve the railway system. Tense negotiations to finalize the package took 2 days.
Das heißt, wir konnten nicht nur einfach ein Konjunkturpaket. We couldn't just set out a stimulus package that was done in the traditional sense. Rather, it had to be a package of measures that contained a view to the future, and this is precisely what we have emphasized. The package will amount to 130 billion euros for the year 2021, of which 120 billion will be spending by the government.
Italy's pandemic loan program is under fire. So far, it's delivered just 0.1% of the 400 billion euros it promised to businesses. The delays are partly down to some banks dragging things out because of strict regulations. Government squabbling and bureaucracy obviously don't help the situation. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Let's talk about Anglo-Sino relations, shall we now? The UK and China, relations between the two on a collision course, we understand. British Prime Minister Boris Johnson has criticised China's planned security law in the former British territory of Hong Kong. And on Huawei, the UK is looking at replacements to exclude the Chinese telecommunications giant from its 5G networks. But 2 British banks have come out in support of Beijing. HSBC and Standard Chartered have backed China in the standoff over a proposed new security law. Of course, they have big exposure and presence in China. The bank statements came on the eve of the anniversary of China's 1989 Tiananmen Square crackdown. Prominent Hong Kong activist Joshua Wong called on the business community for support.
It also implies how Hong Kong business company and the economic freedom is being threatened by Beijing. So I think now is the critical point to not only seeking for the support of the general public, business, and also important to have businessmen to support us.
Joining us now is Dr. Yu Jie, Senior Research Fellow on China at Chatham House. Dr. Yu, really good to speak to you. So we start this conversation talking about the relationship between China and the UK, but of course we can broaden it to tensions between China and the US, because there's plenty to talk about on that front as well. But on the specifics around the Anglo-Chinese fallout, what do you expect to come of Britain's stance around Hong Kong? What difference will it make, this British intervention around UK passports, for example?
Good morning. Thank you so much for having me. So far, what we have experienced is there's quite a lot of war between two countries, and especially, op-ed written by Prime Minister, and then this foreign affairs spokesperson from China saying, do not interfere domestic affairs. So, so far, I did not really see any actual move from either government. And what would happen? I think what we have to take a wait-and-see mode to see exactly how Beijing is going to proceed with this national security law, does that really mean really the end of the rule of law in Hong Kong? We are not sure yet. I think perhaps it's too early to draw the conclusion to see the two countries will be on coalition mode.
How much do you expect this national security law, Dr. Yu, to limit the freedoms of people in Hong Kong? For example, would people in Hong Kong still be able to protest against other things happening on the mainland or even in their home territory? Would they be able to commemorate still Tiananmen Square?
I mean, I'm not a legal expert as such. I mean, from what I know, really the core economy of Hong Kong come in three strands, and those strands are trade, services, and tourism. So given what's going on in the last summer with all the thousands of protesters running around the street, and clearly tourism has just gone down completely. And then if we're talking about trade and services, I mean, without really a stable environment, you can't really just carry on trade and services. So this will bring a very major economic damage for the Hong Kong economy as well. And I think that's perhaps part of the reason why Beijing has decided to introduce this national security law.
How unexpected is Beijing's stance here, Dr. Yu? Because at the time of the handover, there was an agreement, of course, around two systems, one country for 50 years. Was there always an expectation that Beijing would act this way towards Hong Kong, but just not yet? Has this move just come too soon for the West? Was it always inevitable?
Well, I think it's really down to what had happened in the last summer, and also things happened back to 17 years ago when Hong Kong was trying to introduce this national security law, Article 23, and then for some reason, because the Hong Kong legislature did not enact the entire act completely, and therefore I think considering what had happened in the last summer, and Beijing has decided to take initiative itself. So ultimately, Beijing perhaps will do it, but not in such a quick stage. But I think we have to put into context on what happened in the last summer.
How important, Dr. Yu, is Hong Kong's status as a financial hub, the economic output it generates as a financial hub? How important is that to Beijing? I mean, would they be willing to reduce the financial product of Hong Kong in order to take control?
I think still at the moment, I think Hong Kong as an international financial center for China is important, although not as important as back to 20 years ago since China joined WTICO. And part of the reason is because Beijing now has Shanghai and also Shenzhen. But if we're putting in a bigger context of the U.S.-China relations, if the Chinese companies gradually retrench from the United States, and perhaps Hong Kong has become the solo financial platform for the Chinese companies to put on their IPO, if they want to present it as being an international company.
Do you think, Dr. Yu, in terms of China's end goal here, is reconciliation with the West, with the United States, with the UK, still very much in China's interests and what they want to pursue, or not?
I think the reconciliation, it is in China's interest, but only with a condition. With the condition that China, in this post-COVID-19 world, China has now become more self-reliant. I mean, if we're judging by the policy result from the National People's Congress last week.
Sometimes a few months feels like an eternity. And sometimes an eternity is transformed in a matter of minutes. So that time doesn't proceed in a straight line. You know, before the Soviet Union collapsed in 1989, nobody foresaw that. Nobody could imagine, in or out of the Soviet Union, that it would disappear. But it did. To use the old language, the contradictions and the tensions accumulated below the surface, but when they blew, things went very, very quickly. So it may take a long time of lots of little demonstrations, and then
to confront protesters as his predecessor issues a scathing attack on the president. We'll get the latest from New York. This is Bloomberg.
terms of what I was saying and thinking in the first half of this decade, what overwhelmed me at that time was a sense that the American people and the economics profession, which is what I've been doing all my adult life, had simply not wanted to take account of an absolutely crucial event that begins this decade. I'm not talking about 9/11, obviously an important event. I'm talking about a financial event. In March of the year 2000, the first year of this decade, the American stock market crashed. I use the word advisedly. It crashed. The NASDAQ, which is really the most important of our stock markets now, reached a level around that time, a peak level of 5,000, it's an index of the stock market. It collapsed. It is today half or less than half of 5,000. It collapsed and it never recovered. And I remember thinking and talking with my colleagues, there is no way you can have a country as focused on stocks and stock markets as this one is, experience a collapse in a short amount of time of that magnitude without it shaping and teaching you about what's going on a scale that would require a massive discussion in this population, what to do, what this means, and what to do about it. We had none of that. We had a panicked government, so terrified that that collapse of the stock market would usher in a major recession, that they took an unprecedented step. They collapsed interest rates in the United States, drove them down faster, further than we had ever seen the Federal Reserve.
Rhetoric. He wrote, Donald Trump is the first president in my lifetime who does not try to unite the American people, does not even pretend to try. Instead, he tries to divide us. End quote. As protests continue for a ninth night, Minneapolis has upgraded charges against former police.
By scientists, we are doing something never done before until now to save the planet and endangered species.
To do so.
On average,
is customary, and we have a very powerful National Guard, over 300,000 men and women, and we can do pretty much whatever we want as far as that. But as far as going beyond that, sure, if it was necessary.
The option to use active duty forces in a law enforcement role should only be used as a matter of last resort, and only in the most urgent and dire of situations. We are not in one of those situations now. I do not support invoking the Insurrection Act.
I commend the Secretary of Defense, Esper, for taking the position that he took, because military leaders, almost in unison, do not believe that our military ought to be used to fight our own people. It ought to be used to fight foreign enemies.
Let's get now more on this from New York. Bloomberg's Anne-Marie Hordern joins us. And Anne-Marie, a really stinging rebuke then from Trump's first defense secretary making this intervention.
Yeah, absolutely. He really ran after President Donald Trump in this statement, which was published in The Atlantic. Absolute condemnation against the President of the United States, and it's just extraordinary in the sense that the military is usually very apolitical. So that is why this is going to get a lot of attention, certainly from the Democrats. The question is whether or not how much mileage it will have. He hasn't been in the post for 18 months, but it does strike at the heart of what President Donald Trump has wanted to make about his administration, as well as what he's been talking about the past few days, which is a strong military and the praise of the military. And this was his first defense pick, Secretary General Jim Mattis. And he was revered and respected so much when he was in the cabinet. And I was speaking to John Harney earlier, and he said he can't imagine another time where we've had a sitting president be so castigated by a former member of his cabinet. And that is why this statement is really extraordinary right now in the United States and the entire political sphere.
How has the president responded to all of this, Anne-Marie?
Well, he went to Twitter, his favorite choice, really, when he wants to hit back. And he said that it was an honor of his to get rid of this first defense secretary, speaking about Mattis, and branded him the world's most overrated general. These are his words. His press secretary said that Mattis was doing this as a stunt to.
Of course, we'll look at Washington, where U.S. jobs and employment data are also due. Now let's get straight to the Bloomberg. First Word News here in London is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Former Defense Secretary Jim Mattis has strongly criticized the president's handling of unrest across the U.S. He says President Donald Trump tries to divide the American people, accusing him of making a mockery of the Constitution. It comes amid uncertainty around the current Defense Secretary Mark Esper's position. He publicly opposed the president's idea of deploying the military to contain protests. Germany's ruling coalition has agreed on a 130 billion euro stimulus package. The wide-ranging plan is even bigger than expected. It includes a temporary reduction in VAT, as well as money to build 5G networks and improve railways. Tense negotiations to finalize the package took 2 days.
Das heißt, wir konnten nicht nur einfach ein Konjunkturpaket. We couldn't just set out a stimulus package that was done in the traditional sense. Rather, it had to be a package of measures that contained a view to the future, and this is precisely what we have emphasized. The package will amount to 130 billion euros for the year 2021, of which 120 billion will be spending by the government.
A mass vigil to commemorate the military crackdown on Tiananmen Square has been banned for the first time in 30 years. But protesters in Hong Kong still plan on commemorating the anniversary. Events include an online gathering plus smaller rallies across the city. When banning the commemorations, officials cited social distancing measures due to COVID-19. Global news 24 hours a day, on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the ECB will decide today whether its already massive monetary stimulus needs to be boosted even more to help haul the region out of its deepest recession in living memory. The central bank is widely expected to boost its pandemic emergency purchase program by 500 billion euros, even though so far it's spent less than a third of the 750 billion.
Cutting back in states. In California, tens of thousands of state employees have been fired. Teachers, crossing guards, policemen and women, and all of that.
because supply is waning. But this is also something that was expected, and we would probably fade the move over the short term at least.
It was very clear. We heard from Madame Lagarde, Frédéric, a couple of weeks ago that looking at the range that they were expecting the economy to fall by, we're on the weaker end or we're on the worse end, and we're not going to get the kind of rapid recovery that maybe we could have expected. When do you make a call on what kind of recovery we'll see, given the economies in Europe? Most of them have been open for a couple of weeks.
Well, personally, I've stopped making forecasts. Well, we are tracking, alternative data. We're doing our best to track the recovery. We are encouraged by the recent news. On the other hand, when you look at PMIs, they are supposed to be the best indicators to track this recovery. And right now, they make little sense in to the extent that, for instance, we are not above 50 in Europe, where the month of May should have been better than April. So there are mixed signals, but let's not lose sight of the bigger picture. The ECB staff projection, as you said, will be revised lower because Christine Lagarde and others have said so, around minus 10% GDP this year. This is something that is of historic proportions. If you look at a Taylor rule that worked quite well in the past for the ECB, it would suggest that the ECB would need to cut rates by 500 basis points and do several trillion euros in additional QE. So obviously it's not that simple, but the conclusion is very clear in the sense that they need to do more to be proportionate, to use the German constitutional court term, relative to.
Welcome back to the first trade. Let's take a look at one of the companies we're watching on yahoofinance.com. That is Macy's. The company released its preliminary first quarter results this morning and held a conference call with CEO Jeff Gennette with JP Morgan this morning. And we find our Inez Ferre, who was on that call. Inez, what'd you learn?
Yeah, Brian. Well, Jeff Gennette basically laid out the numbers that they're expecting, these preliminary sales numbers for the first quarter, with net sales coming in at approximately $3 billion and an operating loss of anywhere between $1.1 billion and $905 million. And those ranges exclude store impairment charges. Now, all of Macy's stores have been closed, were temporarily closed on March 18th. They have begun reopening starting on May 4th. And what I found interesting was some of the commentary that was on that call from CEO Jeff Gennette, talking about digital business, how it will become increasingly important. It's expected to pick up more quickly. Now, the company did see an uptick in digital sales in April. They've been offering curbside pickup. But he also said the recovery will be gradual, and for a period of time, we will be a smaller company. And also what I found interesting was the color from CFO Paula Price. She said that the company had to take a significant inventory write-down, some $300 million, which hurt gross margins. Also, they saw a slowdown in credit revenue. The best channel for them to acquire new accounts, of course, is inside their stores. And since their stores were temporarily closed, that hurt that. Also, delinquencies accelerated because of the unemployment situation. She also said that it'll take some time to reach a stabilized level of sales well into 2021. And she said perhaps into 2022, Brian. Right now, the stock is up more than 4%. But if you just take a look at a year-to-date chart, that's down 68%, Brian.
All right, Inez Ferre, thanks so much. Yep. From one iconic brand to another, except this one is doing well. Apple is fixing its Face ID to allow users to unlock their phones while wearing a mask. Here to discuss is Yahoo Finance's tech editor, Dan Halley. So, Dan, have you tried this yet? Is it out?
It's out now. It's part of the most recent iOS update for iOS 13. And what will happen is when you have a mask on, rather than failing multiple times and then having to, tap, 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 you'll be able to swipe up. And then that will allow you to get to the automated digit type in. So basically, you'll just type in your numeric password, and then you'll be able to go into iOS no problem. It's something that they've had to deal with because of the masks. There were some workarounds. My wife had figured out one where you could put half a mask covering your face and then re-register your face for Face ID. But this is a much simpler way to be able to get around that while still ensuring you can use Face ID on a normal basis when you're not wearing a mask. And this is also the iOS update that includes the APIs, the application, basically program interfaces for health authorities to start using health tracing or tracking that will allow them to build out those COVID-19 tracking softwares that Apple and Google have been talking about. Again, that's not going to track you all the time or your location specifically. It'll just let other people know who have the app installed whether or not you've been infected with COVID.
So I guess I had wishful thinking here, Dan, because I thought the fix would mean that it could still use Face ID while I was wearing my mask. But that's not the case here. You're saying we still need to put in our numerical password.
Yeah, because if
children the American dream of living still better. Suppose suddenly that the one thing that made that all possible, rising wages, stopped. Suppose the 1970s was the end of rising wages and they never rose again, which, by the way, is exactly what happened. What would these people do? Of course, they could decide, well, happened to be born at the wrong time, so the American dream is over, and I tell my children, screw you, it's not going to happen for you. I'm the last one. You can't go to community college because the money isn't there. You can't. It's over. Well, we might have had such a population reaction if there had been a national debate about, wow, the world has changed. Our history is now different. We have to make up. None of that happened. There was no discussion at all. So each American working family experienced this as their own failing. I'm not able to deliver the American dream. Other people are, but I'm not. So I've got to be the disappointing parent that tells the children, you're not going to get the good news. You get the crap. Most people can't do that. And if the cost of participating in the dream, even when your wages don't permit it, is for you to go into debt, that's a small price to pay. The party continued. From the 70s through 2, 3, 4 years ago, Americans convinced themselves that they could eventually pay it off, that there would be a better job down the road that would allow them to pay down the credit card. Meanwhile, they could deliver to their wife, their husband, their children, the kind of medical care, the kind of education, the kind of occasional vacation. Come on, we're the people who invented advertising. We're the people who define consumerism. We measure one another by the house we live in, the neighborhood we live in, the car we drive, the clothes we wear. You know the story. That's not because we're peculiar people, because we lived in a culture that celebrated this consumerism.
Welcome back to the first trade. Let's get right to Inez Ferre for a closer look at the markets. Inez?
And Brian, we're looking at a flat picture for some of the indexes, but we are taking a look at some tickers this morning. AstraZeneca, that's a British drug maker. Take a look at this stock. It's up more than 4%, around more than 3% right now. The company has received $1 billion in U.S. funding to develop a coronavirus vaccine candidate, and the agreement would make some 300 million doses available to the U.S. if the vaccine proves to be successful. And the vaccine is expected to go into a phase 3 clinical trial in the U.S. this summer. Then taking a look at Aurora Cannabis, that stock is up more than 26% today after the company has agreed to buy U.S.-based CBD company Reliva, which has access to about 20,000 retail locations. This is an all-stock deal valued at $40 million, and this would give Aurora a big footprint in the U.S. in the CBD market. And just taking a look, though, at the year-to-date stock of Aurora, that's down about 37%. And then looking at Canada Goose, that stock relatively flat today after the company says that it has permanently laid off 125 workers. Its stores were temporarily closed in March in North America and Europe, like so many other stores, because of COVID-19. It also withdrew its full-year guidance. Brian?
Thanks so much, Des. The U.S. housing market is looking bleak right now, with existing home sales falling nearly 18% month on month, the most since July 2010. Across the country, city dwellers are fleeing to suburbs to seek some coronavirus relief. But could these moves forever change the real estate landscape? Joining us now is Noah Kaplan. He's the host of $1,000 Listing, a show that helps New York City residents find affordable housing and other options. Noah, where do you find these $1,000 listings? Do they exist?
I'll tell you, Brian, they're plentiful. They are out there. If you divide up an apartment, if it's a four-bedroom apartment, you could rent it outright, or you could get a bunch of millennials, Gen Z, or any age group for that matter, to come and move in there, and they become a Brady Bunch. I mean, it's great.
Okay, I don't know. I was never into the whole Brady Bunch kind of living dynamic, Noah, but I hear you. What about rents in New York City, in big populated cities like New York during this pandemic? Are you seeing rents starting to come down? And if so, do you think it's something that might last for a while post this pandemic?
I do. First of all, yes, to answer your question, rents are definitely coming down. We've actually seen in the last, just in the last week, we've seen rents